Good afternoon, ladies and gentlemen. We extend a very warm welcome to you for today's virtual CPE meeting. We have two technical sessions for the day. First one on common non-compliances and general non-disclosures under Ind AS and AS, and second session on Schedule 3 Companies Act 2013. The program has been organized by Financial Reporting Review Board, FRRB of ICAI, and hosted by Chengalpattu District Branch of SARC of ICAI in Chennai. We are very thankful to the Chairman, FRRB, Shri Durgesh Kumar Kabra, and Vice Chairman, Shri CA Abhay Chachid, for FRR and FRRB team in Delhi for giving us an opportunity in hosting this program today. Financial Review Reporting Board was constituted in July 2002. It is an important wing of ICAI that works to bring improvements in financial reporting practices and thereby promote investors' confidence in auditing the financial statements. FRRB reviews the general purpose financial statements of enterprises and auditors report thereon with a view to determine the extent possible the compliance with the GAAP in preparation and presentation of financial statements, compliance with the disclosure requirements prescribed by the regulatory bodies, statutes, rules and regulations relevant to the enterprise, compliance with the reporting obligations of an auditor. FRRB creates awareness among the members through its publications too. FRRB has initiated to organize awareness programs on financial reporting practices, updating the knowledge of the preparers of the financial statements and auditors with the amendments taking place in financial reporting framework, and also to apprise them about the common and non-compliances and compliances which are observed by the board during their review of financial statements. Such programs are well appreciated among the members of the institute, which are reflected from the overwhelming participation of the members in the program today with us. Today, friends, we have among us two very learned speakers and experts who share their immense knowledge and expertise with us. We move on to the first technical session on common non-compliances and general non-disclosures under Ind AS and accounting standards. We welcome Shri CA Aditya Kumar. He's a partner, RGN Price & Co. Chartered Accountants. He's a fellow Chartered Accountant from ICAI. He has completed Diploma in Information Systems Audit. He has completed certification in Forensic Accounting and Fraud Detection, certificate in Business Responsibility and Sustainability Reporting. He's also completed certification in International Financial Reporting, International Standards of Auditing and Robotics in Finance, UK. CA Aditya is a partner in his firm since 2017 at Bangalore office. He specializes in accounting standards and other financial reporting aspects. He's a speaker in various professional forums like Society of Auditors, CA Study Circles, branches of SIRC of ICAI, and others. He contributes literature on topics of audit and assurance, financial reporting aspects to journals like Auditor published by Society of Auditors, Internal Audit Today, published by Institute of Internal Auditors of India, and other blogs. He has co-authored on AI in financial services and contributed to leveraging data analytics in internal audit. Thank you, sir, for taking time for us today in your busy schedule. We welcome you, sir. The floor is yours.
Thank you, Priya. Thank you for the introduction. Can we start the presentation?
Yes, sir.
My screen is visible.
Yes, sir. Can you enlarge it, sir? Yes, sir. Perfect, sir.
So today's session, we are talking about looking at the financial statements of various companies. And the FRRB has reviewed those financial statements, our annual reports, I would say, and has identified that there are certain non-compliances with accounting standards or Ind AS. Now, throughout the presentation, I'll be taking you through certain specific non-compliances which has been identified by FRRB. Just to add, we are not here to look at certain mistakes that has been there in the financial statement, but what we are trying to do is trying to learn from the mistakes and see how we can improvise our financial reports, how it can add more value to the readers of the financial statements and the stakeholders at large. So that's the context in which we are having this program. Second thing is, now it's the peak time and most of the statutory audits are getting over. Of course, for the listed companies, largely it would have got over, but then for other companies, it would have just picked up. And I guess this is the right time to relook at the practices that we have been following for quite some time and see where we can improvise it. So that's broadly the agenda, where we will look into precisely the literature which is available online of FRRB. So that's the cover sheet of the material that I have used in this presentation. Of course, there are other materials that are also available in the Institute's website, especially on the FRRB section, where these reports are available, which can be downloaded and read by everybody to make the financial statements better. Now, in this presentation, I have taken at least the latest case studies that is available, selective observations, because that's a huge book and it's not possible within 1 hour to go through all the observations, but at least the selected observations and the commonly made mistakes, etc. And some of the issues what we are discussing accounting standard could also apply to Ind AS or vice versa also. So that is the context in which we need to look into. So to start with, I have started with the two sections. One, based on the allocation in based on the presentation in the balance sheet, starting from property, plant and equipment to other assets and the borrowings, and then we will go on for the accounting standard related issues. Now, typically when we look at the property, plant and equipment, the standard that would apply would be AS 10 for AS companies and in AS 16 accordingly. Then you also have related standards like borrowing cost also that needs to be taken care of. Now, as far as the property, plant and equipment standard is concerned, it talks about when can you recognize something as a property, plant and equipment, what are the measurement requirements, and how are you going to value it at initial stage, and subsequently then comes the disclosures. Apart from that, we also have certain items in Schedule 3 that requires specific disclosures. Now, what FRRB has observed in property, plant and equipment is, the first one they have observed is mentioning in the accounting policy as subsequent expenditure relating to an PPE is capitalized only if it increases the future benefits from the asset beyond its previously assessed standard of performance. So possibly the contention of the company is that since I have spent money and I'm expecting the performance of the asset to improve, therefore this is being capitalized. On one hand, you can argue saying that yes, there is some merit in saying that, but if you look at the standards, it also requires the company to follow two other things, and the two other things are, one is the subsequent expenditure would be recognized in the PPE when it meets the recognition criteria under para 7. That is, there has to be a probability of future economic benefits associated with the item to the entity, and the cost can be measured reliably. Now, there are two parts. One is the probability of future economic benefit, and then the cost that can be measured reliably. So the context in which FRRB is making this observation is, it is just not sufficient to say that because the standard of performance will improve, I am capitalizing. Go back and check para 7 and para 13, where it says that whether the cost can be measured reliably and the future economic benefits is possible to be generated. If these two conditions are met, only then you can capitalize. So to that extent, there is some lack of clarity in the accounting policy is the conclusion that FRRB has. The second observation they had with is regard to capital work in progress. Now, typically, if you look at the schedule of property, plant and equipment, it always starts with on one side, it starts with the gross block, additions, then deletions and the closing block, and the accumulated depreciation columns, and then the closing net block. It also gives a reconciliation what is the additions and deletions. Now, they have found that companies are not giving this information with respect to capital work in progress. So the FRRB view is also that capital work in progress is also part of PPE, and therefore the reconciliation also needs to be given to capital work in progress as what is the opening balance, what are the additions, less what is deletion. Deletions here will be what is capitalized during the year, less capitalized during the year, and the closing block. So this is the requirement under the accounting standard. The third requirement or the third observation that was found is depreciation on leasehold improvement is provided over the primary period of lease or over the useful lives of respective assets, whichever is lower. Now, typically in a lease agreement, there will be, say, a clause which says that first 5 years there will be an agreement, for example, and there's an opportunity to renew the lease. So that is called as the secondary period, if we can call it. Now the question is, should we take only the primary useful life or should we take it the possible secondary life also of that asset? Now FRRB is of the view that under Ind AS 16, the lease term should be considered, which also includes the legal life of the asset. And if there is an option to extend the lease, that also needs to be considered. So if there are such options available, and there is a likelihood that the company is also going to use that extended option, then the depreciation over the leasehold property will be over the extended period of lease and not just on the primary period of lease. So this requires a bit of analysis from the company side to determine about that and then take a call. This would also actually come in the lease accounting under Ind AS 116 accordingly. The fourth observation that they had is toll equipment. Toll equipment is classified as an intangible asset, but depreciation is charged, which is incorrect. Because typically for an intangible asset, it is amortization that will happen. Amortization accounting and depreciation accounting could be akin, could be very similar, but the typical technical word that is used is amortization for intangible assets. Now here, what has happened? It's a property, plant and equipment classified as an intangible asset. Therefore, the classification is incorrect. It should have been classified as property, plant and equipment. The next observation regarding property, plant and equipment was capitalization up to the date of commercial operation has been done. So they have, it could either be a factory or it could be a large construction where they have picked up the point as to when we have to capitalize it, and possibly they have picked up the date on which the commercial operation has started. Now, Ind AS 16 para 20 says that recognition of cost ceases when the item is in location and condition necessary for it to be capable of use. It may not be put to use, but it has to be ready to be capable to be used. Put to use is to my understanding, is a terminology used in tax and not in the accounting standard. So it is typically when the asset is capable of being used, then it has to be capitalized. Now, why they say don't look at the commercial operation is it is quite possible that the asset would have been ready to use, but for some reason there is delay in commercial operations or something else has happened. So would you then not capitalize the asset at all is the question. There were other issues relating to, say, the borrowing cost. Borrowing costs directly attributed to the acquisition of fixed assets are capitalized as part of the cost of the asset. So when an entity takes loan or takes any financing facility, the borrowing cost is eligible to be capitalized only if it is permissible under Ind AS 23, saying that capitalization is permissible only when it is a qualifying asset. So they have defined what is qualifying asset under Ind AS 23, where it takes substantial time to complete, typically a year's time, subject to certain other conditions. So merely mentioning that borrowing costs have been capitalized on fixed assets would lead to read that even if it is not a qualifying asset, the borrowing costs have been added, and therefore it will be in non-compliance with the standard. Next one is on the leasehold land, which is not amortized, which again the FRRB is of the view that it is not in compliance with Ind AS 16 because it is not your land. you have taken the land on a lease for a particular period of time, and that also has to passed on over a period of time. That has to be amortized, is the view of the FRRB. Then there are cases where there is an absence of accounting policy on land acquired under finance lease. So here again, the issue here is, if you look at the balance sheet and the financial P&L account and others, there could be certain line items, but the corresponding accounting treatment given is not available in the significant accounting policies. So one way to check is, once the financials are available, we need to tag the accounting policy with the financial statements, right? Balance sheet, P&L, notes, etc. To see, is there any item which is there in the balance sheet, P&L, notes, which is not there in the significant accounting policies. Only then we can say the significant accounting policy document is complete in all respects. Then there is a note given in one of the company's annual report which says assets not owned by the company are amortized over a period of 10 years. So this again raises a question on, if the asset is not owned by the company, how is it then accounted? And where is the question of amortization? So this was typically found in one of the companies where Ind AS applies, and para 7 of Ind AS 1 clearly says that if you have certain information which is obscured or camouflaged or not provided adequately, then nobody can make a sense of what is actually written. That tantamounts to non-compliance under Ind AS 1. So these are some of the observations under the property, plant and equipment, wherein they have spoken about the cost of the asset, they have spoken about the disclosure requirements, they have also spoken about non-compliance with other related standards like borrowing cost, etc. Now coming to the intangible assets, which is the next schedule or the next section, typically we have found that in any intangible assets you have two types broadly. One which is like patents, trademarks, copyrights, where there's a cost incurred and it is amortized over the legal life. Now the challenge is on the self-generated assets, where the company has brought its own product into the market which is eligible to be capitalized. In such a case, the standard is clear that all the research expenses that needs to be written off, and it's the development expenditure only that needs to be capitalized, and this development expenditure is also has to be tested for impairment because it doesn't have a specific life that can be attributed. So research and development expenditure, now in the accounting policy, this particular company has mentioned that research and development expenditure is charged to revenue under the natural heads of account in the year in which it is incurred. Research and development expenditure on PPE is treated in the same way as expenditure on other PPE, which is incorrect because the capitalization requirements under PPE are quite different from the expenditure which needs to be capitalized under the intangible asset standard. Similarly, revenue expenditure on research and development is charged to the statement of profit and loss in the year in which it is incurred. Capital expenditure on research and development is treated as fixed assets. So this is not in line with Ind AS 38. So typically what should happen is, wherever the expenses are incurred on research activity, that gets written off in that year of research, typically as a separate line item as research expenses. Those expenses which gets capitalized as a development cost will come and sit in the intangible assets schedule as the development cost incurred. Suppose if you are a company where employees have been used or their services are being used to develop a product, in those cases, typically the ideal presentation would be under the employee benefits, you put the gross amount less expenditure incurred towards developing a product, and that amount will come in the intangible asset schedule, so that the reader of financial statement would actually know what is the employee benefit cost that has gone into developing a product. Now, it is very essential for the companies actually to draw a line and evidence that where has the research got over and where the development has actually begun. I do agree that there are some practical issues there, and there is sometimes it's a very gray area to clearly say where the research has ended and where the development has started and how it should be accounted for. But then it's like a management judgment or estimate wherein you have to clearly bring out in your financial statements as to what is the management's decision on this particular aspect and how they are in compliant with the accounting standard. So there are some technical issues here, I agree, and these technical issues vary from company to company, industry to industry as well, as to when the research is over and when the development activity would start. So primary issue the FRRB has is on classification of research expenses and capitalization of development expenses. The second area where they were looking into is, especially during the time of transition to Ind AS, where the company has opted for the deemed cost of the intangible assets, etc. So in this particular case, there's when it says deemed cost, they should have taken the net block and then they should have started it. But the presentation in the financial statements is not correct, and therefore the FRRB viewed that this is not in line with Division 2 of Schedule 3 to the Companies Act. So there is more of a presentation issue there. So other non-compliances that FRRB has also looked into is incorrect classification of land and building, especially between property, plant and equipment and investment property, both under accounting standard. Of course, accounting standard may not have a separate standard on investment property. There is mention about that in AS 13, whereas under Ind AS you have a specific mention about or a specific standard on investment property. More often than not, we have also seen, this is not in FRRB, but this is my personal experiences. Typically, when it comes to preparation of consolidated financial statements, where say the holding company has let out its property to say another company in the group, yes, it is right to show it as investment property under Ind AS. But when it goes back for the consolidation purposes, we will have to relook into the classification, and then at the consolidation level, it will have to come back to PPE because there is no rental income or it has not been let out outside the group. So that is again, certain subtle changes are required within the classification of these assets between the accounting standard, between the standalone financial statements and the consolidated financial statements as well. The second common observation is not identifying the components of PPE for capitalization, especially where the components life could be different from that of the entire PPE. Now, typically after Ind AS 16 has come up and AS 10 has been revised, you may have to look at the component-wise accounting, wherein determine the life of the component. But again, maybe because of practical reasons, many companies are not doing it, but I would suggest to look at it because that would be more in compliant with the standard. The third issue is regarding incorrect classification of stores, spares, tools between property, plant and equipment and inventories. So there is again doubt whether this has to be considered part of the inventory or should be considered part of the PPE. The definition of PPE is very clear that where you are going to have these items which can be used for a period beyond one financial period or year, it has to be taken as PPE. This again is certain area where the companies can have a look at it on the classification of PPE and inventories especially. And there's also a case where the accounting of profit on sale of PPE has been taken to other equity, which typically is not correct. It should have been into the P&L account or the statement of P&L. Now coming to the non-PPE and intangible assets, we have investments, we have financial instruments, etc. Now with regard to investments, typically you have AS 13 which covers under accounting standard, and you have host of other standards in Ind AS like Ind AS 109 for the purpose of recognition and measurement. Then you have 107 for disclosure, then 32 as well. Now, what FRRB has observed on the left-hand side of the slide that I have put up is various accounting policies picked up where they say current investments are stated at lower of cost and net realizable value, or current investments are valued at cost or market value, whichever is lower. Current investments, if any, are carried at lower of cost and quoted/fair value computed category wise. Short-term investments are valued at lower of cost and market value compared on a scrip-wise basis. Then there are current investments are valued at lower of cost or fair market value. These are the various accounting policies that FRRB has observed. But the correct position of the standard in para 31, it says is investments classified as current investment should be carried in the financial statements at the lower of cost and fair value determined either on an individual investment basis or by category of investment, but not on an overall basis. So that is the text given in the FRRB book as well, that this is how it has to be done. Then they also mentioned that when it comes to what is a fair value, the amount for which an asset could be exchanged between a knowledgeable willing buyer and a knowledgeable willing seller in an arm's length transaction. Under appropriate circumstances, market value or net realizable value provides an evidence of fair value. So in all the standards, we keep using the word market value, fair value, and net realizable value. Net realizable value is after deducting any expenses required to make the sale, etc. Even between fair value versus market value, there are subtle changes. Typically, if it has more guidance given in India as 113, where they say how is a fair value being computed for a listed security, for an unlisted security. So if you look at that, market value need not be the fair value always, but it's one of the guiding factor. So when the accounting policy is written, it seems to have used all sorts of terminology. One of the suggestions that I can give is stick to the wording given in the standard. That will help. The third aspect here is using the terminology between current, non-current, long-term versus short-term. Now, if you look at the guidance note again given by the institute, it typically talks about how you are going to account for the investments between current and non-current. Now, this is the extract from the guidance note. If you look at the extract, it clearly says, especially the third paragraph, 7.4.2, it says, though the Schedule 3 clarifies that accounting standards would prevail over itself in case of any inconsistency between the two, it is pertinent to note that AS 13 does not lay down presentation norm. So the presentation norm is laid down by Schedule 3, though it requires disclosure to be made between current and long-term investments. So presentation of all investments in the balance sheet shall be made on current and non-current classification. But the language that is used in accounting standard is short-term investment and long-term investment. They are not the same. Why they are not the same? It is because the portion of long-term investment as per AS 13 is expected to be realized within 12 months from the balance sheet date should becomes a current asset as per Schedule 3. So there is an understanding issue here between the standard and the Schedule 3. The Schedule 3's benchmark is always from the date of balance sheet, whether something is current or non-current. What is required under AS 3 is short-term or long-term based on the date of investment. So if you look at 7.4.1, it's very clear that AS 13, the assessment of investment as a long-term has to be made with the date of investment. Whereas as per Schedule 3, non-current investment has to be determined on the balance sheet date. So obviously this will not go together. So this is where we need to understand that yes, under AS 13, it could be a long-term classified as such. But when it comes to the preparation of financial statements, it may have to go to current also if it is getting realized in the next 12 months. So this is something which we have to be extremely careful, because many times it is taken for granted that what is long-term is also non-current, and it gets classified under the wrong head of account or under the wrong head in the balance sheet. So this is a guidance which needs to be kept in mind. Now, with regarding to investments, to continue with the investments again, there is no provision that was made for diminution in the value of investments which are of long-term in nature, or the accounting policy simply says long-term investments are stated at cost. Then they bring in wordings like being provision for diminution in value in the perception of the management will only be considered, right? So these definitions or these things given in the accounting policies does not go well with the accounting standard. The terminology here used is a provision for diminution shall be made to recognize a decline other than temporary in the value of investment, and such reduction being determined and made for each investment individually. So here the accounting policies, the way it is being drafted, is not in line with accounting standard 13. Then comes the cost. Cost includes interest attributable to funds borrowed for acquisition of investments. So here, what is that investment? Investment is in equity instruments. So equity instruments does not qualify to be a qualifying asset under AS 23, and therefore the accounting policy to say that I have incurred certain interest for the funds borrowed to acquire the investments in equity instruments has been capitalized. So this again to be read with both the standards. The another observation that FRRB has made is quite interesting. It says that you have an investment in a wholly owned subsidiary, which you have stated the value is nil after writing off the investments. Whereas in the previous year, the value of investment was significant and there was no provision made. In the last year, you mentioned that there is no diminution in the value and it is stated at cost. But all of a sudden, it's a complete write-off. So FRRB was of the view that you should have made a provision on the in the earlier year itself, when you could have got that the subsidiary is not doing well and therefore the decline in the value need to have been provided earlier. Investments considered as stock in trade, incorrect, because AS2 does not apply to investments and that accounting policy would not be correct. It would have meant that there's an organization or an entity which buys and sells scripts, that's fine, but typically the rule applies to the AS30, not AS2. With regard to India's schedule of investments and classification under India's 113 on level 1 and 2, 3 were not cross-referenced and the contents did not match, so which again provides an incorrect picture. So typically there has to be matrix sort of presentation which will help listing the investments, classifying it as level 1, 2 and 3, then again further classifying it as whether it has been valued at amortized cost or fair value through P&L or fair value through OCA. So these matrices were there, but it was not cross-referred and the contents did not match. Now coming to other financial assets, and again the classifications. The classification between quoted and unquoted investments, that bifurcation was not made, which is also required by Schedule 3. Other issue was the fixed deposits with banks having maturity period of more than 12 months was classified as investments, which is incorrect. It is not an investment. It has to be treated as a non-current financial asset. Under Ind AS or under AS, it will be a non-current asset. Interest accrued has been shown under non-financial assets, whereas prepaid expenses and balances with revenue authorities has been shown as financial assets. Now, interest accrued is only going to be settled by getting that interest realized. So that is actually a financial asset. Whereas in case of prepaid expenses, this is an accounting entry, money is already spent, the account will get nullified as and when the service is rendered or the product is received. There is no contractual obligation to settle in cash. Therefore, it is not a financial asset. Similarly, balance with revenue authorities also, these are the balances with statutory authorities or statutory obligations. Since there is no contractual obligations, typically it is not a financial asset or a liability. If you have to have a financial asset or a liability, it has to be a contractual obligation, not a statutory obligation. Then there were certain receivables from redeemable preference shares pertaining to an enterprise controlled by the company, whereas that is not shown under related party transactions. So you have in the investment schedule investments in certain companies where you say you control it and therefore it's a subsidiary, but then that transaction is not reflecting under the related party transactions. So again, another area where FRRB is saying be careful, because accounting and disclosure in one schedule can have ramifications in disclosures of other schedule. Similarly, non-cumulative redeemable preference shares has been recognized at amortized cost. However, interest on this investment is valued at amortized cost. That has not been shown separately. So moment you say it is at amortized cost, you should know what is the principal and what is the interest amount. So that is where 107 comes in and talks about a lot of disclosure requirements which has not been complied with. Then the fourth one is quite interesting. Under the related party disclosures, there has been investment in equity shares of a company which has been disclosed as subsidiary. Whereas in MGT9 or the director's report, there they say that this particular investment is an associate. So it could have been a case where in the previous year it was an associate. They have repeated the note without revising it. So these disclosures are contradictory, and again it becomes ambiguous to the reader of financial statement. This is, I'm just trespassing one area of what Mr. Balaji is supposed to take, is on the balances of trade receivable and loans and advances, where many companies write a note saying that these are subject to confirmation and reconciliation. Now here FRRB is extremely clear, reading both SA 705 and SA 505, that if the auditor has to express a qualified opinion, then there has to be a case where this is a material issue, and again there is a requirement that the auditor to say that I am unable to obtain sufficient and appropriate audit evidence. Where you say it is subject to confirmation or reconciliation, it will tantamount to say that auditor is unable to obtain sufficient and appropriate evidence on which the opinion has to be placed. Therefore, this note becomes ambiguous, and it will create a doubt in the minds of the readers of the financial statements. However, on the other hand, if such balances are material and do affect the true and fair view of the financials, then the auditor should have taken this up in the audit report. So where neither the auditor has taken up and neither the statement is unexplained, here FRRB is to view that it is a duty of the auditor to should have brought this appropriately in the audit report. Therefore, the auditor has not complied with SA 705 and 505 is the opinion. Right. Now, on the borrowing side, now we looked at certain assets. If you look at the borrowing side, it was again observed that in the footnote or the notes, the long-term borrowings given in the annual report, it had made certain disclosures in respect of default in repayment to loan to various lenders. Now, wherever there is a disclosure or the requirement, it was viewed that both the components should be mentioned under the revised Schedule 6. Why I have mentioned revised Schedule 6 is this the old FRRB note, which will equally apply to the extent possible in the Schedule 3 also, because that was what was revised. Similarly, there were incorrect classifications where the borrowings were treated as trade deposits, etc., which is incorrect. In one more case, there were again related party transactions wherein the note clearly mentioned that this loan is repayable on demand and it is interest free, etc., whereas it was classified as a non-current borrowing. So not only non-current borrowing classification is incorrect under Ind AS 1, once it becomes a long-term borrowing, typically it also needs to be subjected to fair valuation as well. Now there's an abstract in accounting policy which says financial assets and liabilities at fair value through profit and loss account, and financial instruments which do not meet the criteria of amortized cost or fair value through OCI are classified as fair value through profit and loss. Here the issue is, as far as financial assets are concerned, you have a classification whether it can go through amortized cost or fair value through P&L, and certain instruments like equity instruments on a specific basis it can be fair value through OCI. Whereas financial liabilities, it can only be through amortized cost or P&L. It cannot come through OCI. Now what will happen is, if they write the title financial assets and liabilities, a reader will presume that certain liabilities could have been fair value through OCI, which is incorrect, and this is not in line with Ind AS 109. Then there is a note in the financial statement on borrowings wherein various default in repayment of loans were given, and the auditor's report indicated that there is a delay in timely repayment of dues and status of payment made for these defaults. It was viewed that since the defaults were remedied before the date of financial statements, or rather approval of financial statements, it could have been disclosed. So para 10 Ind AS 107 para 18C requires that if there had been defaults and it has been remedied before the approval of accounts, that needs to be disclosed, which has not been done by the client or the company. This is a quite a big paragraph, but I will try to summarize very quickly. Financial guarantee contracts we didn't have a separate standard in accounting standard, but we have a separate standard, or it is covered under Ind AS 109. Many companies have not accounted financial guarantee contracts as financial instruments. That is one observation. Second is, in this particular case, the FRRB has observed that the company has given a note that the corporate guarantees are in the nature of insurance contracts. If it is an insurance contract, then they should have complied with Ind AS 104, wherein they were supposed to use liability adequacy test and accounted in the manner 104 requires. Having said that, even in 104, there's an option given that certain financial instruments can either be accounted under 104, or if you take the route of 109, then you can always mention that we have complied with 109. So this is something which is not very clear as to how this company has complied with this particular standard. But since it has given that it is in the nature of insurance contract, it appeared that they have not complied with Ind AS 104. Now, coming to standard specific non-compliances, with regard to cash flow statement, two observations that I have is, whenever you have a foreign currency cash and cash equivalent, the unrealized foreign exchange gain or loss should not form part of cash and cash equivalents. You have to show it as a part of reconciliation statement, which many companies have not done. The second aspect is when it comes to the definition of cash and cash equivalents. Again, as we read in investment standard, the same thing here. As far as AS3 or Ind AS 7 is concerned, the investment will qualify as a cash and cash equivalent, but the starting date is the date of acquisition. From the date of acquisition, you take a 3 months time within which if it matures, only then it becomes a cash and cash equivalent. Whereas for Schedule 3 purposes, it is from the balance sheet date. So obviously, again, here there is a conflict in balance sheet date as well as the accounting standard 3 or Ind AS 7. So again, when we go through the guidance note, it specifically says that you can resolve this conflict by changing the heading from cash and cash equivalents in balance sheet to cash and bank balances, and then give a separate note on bank balances and then give a reconciliation statement. So here again, we will have to give an additional note in the financial statement as per cash and cash flow statement, this is the cash and cash equivalents. But if I look into the balance sheet, my cash and bank balance looks different. Why is that different? That needs to be reconciled. So there's nothing wrong if there is a difference, as long as the difference has been reconciled and shown. This is again extract from the latest guidance note given by the institute. There are other issues with regard to classification of dividend income, dividend paid, interest income, interest expense. Typically, this has been going between investment activity or to operational activity. Sometimes it has been shown as financing activity. So I would suggest, if you look at both AS3 and Ind AS 7, they are very clear as to where these things have to be classified, and income tax paid should be shown as a separate line item, not within different line items. So that is one area that we have seen issues. The second is with regard to the use of other comprehensive income. So typically this your cash flow statement starts from profit before tax, and then you add back the expenses and the changes to the working capital, etc. Whereas some companies have also somehow brought in the elements within other comprehensive income, which is which FRRB says is not in line with Ind AS 7. The other discrepancies that they have identified is, though there was no depreciation debited to statement of profit and loss, but somehow it has got adjusted in cash flow statement. We don't know how. A fair value adjustment on interest-free ICDs received from holding company was shown as cash flow from financing activity as a repayment. Then there were proceeds from long-term borrowings, which has been not shown correctly. Again, classification issue. The last one is an amendment to Ind AS 7 about 2-3 years back, wherein they brought out an amendment to show the reconciliation of financing activities. Again, many of the companies have not given the reconciliation. Typically, they are supposed to give in the financing activity what are the opening liabilities, adjustments towards fair value, adjustments to foreign exchange gain or loss, repayments made during the year, any additional financing activities that has happened, and the closing balance. This reconciliation has been found that many companies have not been giving it. Right, now coming to the accounting standard 9 on the revenue recognition. Typically here the issues are based on the point of time of recognition of revenue. So typically in case of services, either it is a proportionate completion method or completed service contract method. But it looks like going to the accounting policy, FRRB concludes that either the revenue has been recognized upfront or the revenue has been deferred. Second, there is no specific language used in the accounting policy which clearly shows that at what point of time do you say that A, the risk and rewards have been transferred, B, that there is no uncertainty existing on the amount of consideration that needs to be received. So typically these are the two observations, and many times even for manufacturing companies also the question is on when is the risk and reward being transferred? That is not very clear. Sometimes companies say sales are accounted when it is dispatched or when invoice is raised. So the accounting policy does not give an indication as to what is the activity you have done, and in that activity, when do you think the risk and rewards have been transferred to the customer? So these three aspects needs to be taken care of in preparation in accounting policies for revenue recognition. In employee benefits, the FRRB has found that they do not contain a note on the nature of employee benefits and its classification. In fact, one of the listed companies also noted that they have their own PF trust and they have been contributing to that. And they have also undertaken that if there is any interest shortfall, the company will actually make it good. But end of the day, if you read, it appears to be a defined benefit plan, but the accounting policy says it's a defined contribution plan. So there is a difference between the way it gets accounted. Similarly, even for the employee benefits, especially like gratuity, which undergoes an actuarial valuation, there are many disclosures that are required from the actuarial valuation report that needs to be included. Now, gratuity again is provided based on actuarial valuation, but many companies have written it that the provision is made based on Payment of Gratuity Act or it is based on estimated basis. These are all the languages not used in AS 15. So AS 15, para 49 prescribes certain things, and that alone can get into the accounting policy. Coming to segment reporting, there are cases where, the company typically in its director's report or in other information, they would have given the breakup of the business, breakup of the products and services. Whereas in the notes to accounts, they mentioned that we don't have any segment to be reported. So again, there is no, what do you call it, as a link between what is given in the financial statement vis-a-vis what is given in other information. So these two also needs to be considered, that people read the annual report holistically and it cannot be read in a single piece separately. Another example here is on a garment business wherein the disclosure under Ind AS 108, they say is not applicable. whereas they say it is not applicable because it does not meet the threshold criteria. Now, the difference between AS 17 and 108 is very different. In 108, we are looking at how the business looks at segment, the CODM, how do they look at the business, how the resources are allocated, etc. Threshold limit is there, but it is not there to determine whether a particular criteria has to be met to show it as operating segment or not. It is only to see whether we can club certain segments. So there is a difference between AS 17 and Ind AS 108 that needs to be understood, and the same reporting cannot continue. Coming to the related party transactions, companies have not mentioned the relationship between the companies or between the KMP, or certain companies have not reported the volume of transactions. So para 23 AS 18 requires both to be given. Like I earlier observation, there's a wholly owned subsidiary formed during the year, but it has not been disclosed as related party. Then various other disclosures which apply, like advance to directors, allotment of shares, repayment of liabilities of related parties. Some of these transactions appear in the schedule to notes, but doesn't appear in the related party transactions. Is also one of the observations that FRRB has made in relation to related party transactions. Coming to Ind AS 24, there were certain corporate guarantees that were given as a security for loan availed by the subsidiary, but there are two parts to it. Here, the guarantee per se needs to have been considered as a financial instrument, and then it should have been accounted. Neither they have accounted that, neither they have complied with Ind AS 24. So typically, they have read the report of holding company, and when they read the report of the subsidiary company, this is the gap that is being observed. Even as simple as accounting standard 20 or Ind AS 33 on earnings per share, many companies don't give the calculation as to how this earnings per share has been calculated. So there is incorrect calculation of weighted average number of ordinary shares. Now the word used is weighted average number of ordinary shares, just not ordinary shares. So many companies have just taken the ordinary shares as of 31st of March and divided it by, or rather the profit divided by the number of shares as of 31st March, which is incorrect. You should calculate the weighted average number of shares and then taken it. Then instead of taking profit attributable to the ordinary equity shareholders, we have seen some places where profit after OCI or the OCI is also been considered, which is again incorrect. Then again, there are disclosures on calculation of numeration or numerator in basic and diluted EPS. So why there is a difference, that needs to be explained. So that reconciliation again is missing in the annual reports. Then the cases where there is EPS is negative, that also needs to be disclosed. There are some companies which think that negative EPS should not be disclosed, which is incorrect. Negative EPS should also be disclosed as the case could be. So just to conclude, this is all I've taken from the references from the FRRB literature that's available online. And to stick with the language of the standard, accounting standard, or Ind AS as the case may be, ensuring that the cross-referencing is appropriate across the notes to accounts, because people are going to read them holistically. And more importantly, it's to connect the dots. I mean, what the numbers speak, what the notes speak, and what the other information. It should convey the same language. It should be on the same page. That is something that needs to be taken care of. How do we overcome it? Just two suggestions from my side is possibly use of checklists that would help in identifying any basic errors. If not, I'm sure checklist is not going to solve 100% of the problem, but at least it will try to point out certain basic requirements and basic things, and possibly review of these financial statements by a quality control partner or an external professional, if possible, would also help to see whether there are any other issues that are in financials which our eyes could not have noticed. But it's always to look at it from a second pair of eyes. So that's the presentation I had. We'll be happy to take any questions if there are.
Thank you, sir. We'll have a question answer session towards the end. In
Sure.
fact, your session was very wonderful. Very interesting observations have been summarized in detail. I'm sure it will act as a deterrent for all of us in preparing the financial statements in the best possible manner. In fact, you've touched upon a lot of topics with respect to the PPE, research and development expenditures, borrowing costs, its treatments, investments, the creditors presentations, the receivables rather, the balance sheet items in detail, the P&L, the cash flows, and the accounting standard parts as well, and the Ind AS. I'm sure we'll have a lot of questions. We will continue with the second session, sir. Thank you.
Thank you, sir. Thank you, madam.
Yes, sir. We welcome CH Balaji for the next session on Schedule 3, Companies Act 2013. Balaji is a fellow chartered accountant practicing in Chennai, specializing in audit and indirect taxation. He has been co-opted as a member, Auditing Assurance Standard Board of ICAI from 2019 to 2021. He is a member of Academic Council of Sri Shankara Arts and Science College, Kanchipuram. He is a member editorial board of Paduka's publications. He is a faculty for CA students. He is a regular speaker at various professional forums on subjects like GST standards on auditing, etc. He has completed his certification course on international taxation. We welcome you, sir. The floor is yours.
Thank you, Priya Madam, for your nice introduction. Thank you, Aditya sir, for your wonderful deliberations with regard to various aspects that a practicing professional or a company has to learn. It's all to it's a very good initiative by FRRB basically to understand in a holistic manner, in a different perspective, that what would be the mistakes or what is the mistakes that have been already committed and how it is to be prevented. So it's a preventive dosage. Vaccination dosage that has been prescribed by FRRB along with Aditya sir's inclusions. Thank you for your guidance on this regard, and also thank FRRB with the Chengalpattu District Branch of ICAI for having this wonderful session to enhance the understanding levels of the basic happenings in the financial reporting review aspects as well as the financial reporting standards. This being the right time where there are a lot of financial statements are getting prepared. There are amendments to Schedule 3, including CARO reporting, which is the topic of the day, where I will be presenting towards, I'll be focusing more towards Schedule 3 amendments relating to CARO 2020. Because CARO 2020, as you can see, there are an entire shift that have changed from 2016 to 2020 reporting, where according to that particular changes which got made in CARO reporting, there are also parallel similar amendments have also been taken up at Schedule 3 perspective, so that it is not only the management's, it's not only the auditor's responsibility to go and report certain new clauses, which are something complicated, something debatable also. So parallelly, the responsibilities have been shifted to the management's perspective also, where the management discloses something in their Schedule 3 and parallelly auditor will also be reporting under CARO reporting here. What is this CARO reporting? Why we need to CARO? First of all, where is the authority that comes for report, or where is the duty for a statutory auditor to report on a CARO perspective is from the Companies Act 2013. That is the base route where there are responsibilities that have been shifted here. Where under 143(9), which talks about the auditor shall comply mandatorily with auditing standards, that's nothing but the standards on auditing, is the first time under the Companies Act 2013 they have given the way in which audit is to be carried out. Under Companies Act 1956, the old law, they did talk only about the qualifications, disqualifications, and the responsibilities and rights of the auditor, but they didn't talk about the way in which audit has to be carried out. It is only based on the standards on auditing that are issued by ICAI, which is a regulatory body where we adopt standards on auditing. However, first time after this particular 2013 Companies Act introduction, the responsibility to comply the manner in which the audit is to be taken is through the Companies Act itself. In 143(9), they categorically say every auditor shall comply with auditing standards, irrespective of whether it is a public limited company, private limited, listed, unlisted, whatever may be the case, the moment it is a body corporate where I'm going to take up a statutory audit, it is mandatory from the auditor's perspective that I have to comply with standards on auditing. That is nothing but auditing standards. These standards are nothing but those same standards that are issued by ICAI that will be looked into by NAFRA. ICAI will recommend it to NAFRA, which is a nodal agency, and NAFRA will vet it. They will make recommendations once again back to ICAI, and then ICAI will modify the standards accordingly, and then it will be further notified by MCA for every auditor to comply with. So there is a sequence of process that is involved in the applicability with regard to the standards. Why it is important in today's context? Because where there are financial reporting ecosystem, which mandatorily requires the auditor to fill this particular expectation gap, where there is an audit expectation gap, where the way in which audit has to be done, there is something called as performance gap, has to be exactly filled in only by the auditors. The performance gap is nothing but the expectations that are put by the regulatory or the legal and regulatory framework, which is to be complied by the auditor, where in fact, if he doesn't comply with, then it enhances this particular expectation gap. So being an auditor, I need to try to reduce this particular expectation gap so that I comply all my legal and regulatory responsibilities in discharging my professional function. This is with regard to 143.9 and 10. But incidentally and immediately after 143.9 and 10, the way in which audit is to be performed, additional responsibility is casted through the Companies Act 143.11 that says that by way of a specific order, the central government may order for inclusion of certain specific aspects, a statement to be included by the auditor in their auditor's report for certain specified companies. So very clearly, CARO is not applicable for each and every company. We need to go and look at the applicability perspective. Then if at all CARO is applicable for a particular entity, then the statutory auditor along with the auditor's report, they need to under the legal and regulatory requirements as discussed in SA 700, I need to include my audit report also. That is nothing but CARO 2020. All along we were doing at CARO 2016. Originally, this was issued in the February 2020, just sometime before the COVID impact. And immediately COVID got into, and then there are a lot of other sufferings. So they have not burdened further with the CARO 2020 reporting. They have relaxed. And from this particular financial year reporting onwards, that we are going for CARO 2020 reporting, which is mandatory for those financial statements ended on 31st March 2022. The auditor has to go for reporting under CARO 2020 also. The base perspective with regard to applicability of CARO, there is no change between CARO 2016 and 20 because we have three benchmarking. One is CARO 2016 and CARO 2020. What are all the changes or what are all the improvements or what are all the areas where I have to be cautious? So I will be always comparing with CARO 2016 with CARO 2020, along with the changes that got made in Schedule 3 because of this particular CARO effect. So how to go and ensure that all the triangle has been rightly complied with. With regard to the applicability part, there is no change when you compare with CARO 2016 and 20 here. So CARO applies to all companies, including foreign companies. What the default provision? So by default, CARO 2020 reporting by the statutory auditor applies to all companies. So they have taken a very quite right blanket. But however, they have given exceptions that CARO does not apply to 5 certain aspects, specifically banking company, because they have a different mode of reporting. Not your Schedule 3 will be applicable. So they have a separate financial reporting framework. So in that particular case, you need not go and have a CARO reporting because more or less the CARO will be from the corporate perspective rather than a regulatory of banking or insurance perspective. So banking companies, insurance companies, Section 8 companies and all are excluded from the CARO reporting perspective. One-person company and small companies, which are all not considered to be material. So they have also excluded these particular 5 types of entities from the applicability of CARO, the same as that of CARO 2016. With regard to a private limited company is concerned, say for example, sir, I'm just a husband and wife or the directors, and then they have a small level of operation being a private limited company, whether CARO is applicable or not. Basically, it applies to all companies, irrespective of the number of shareholders and all, whether it is a public or private. So the point is, for a private limited company also, CARO 2020 reporting shall be applicable. However, there are relaxations that they have provided for. What are all the relaxations? 4 conditions that they have specified. If all the 4 conditions have been cumulatively satisfied, then alone for that particular private limited company, for that particular year, the statutory auditor need not report on CARO clauses. Otherwise, even if one of the conditions got satisfied, So since it's a cumulative conditions, even if one of the condition is getting satisfied here, then for that company, for that year, CARO reporting shall be applicable here. So the 4 conditions that they have specified is, it should not be a subsidiary or a holding company of another public company, and aggregate of paid up capital. So it's an aggregate of paid up capital and reserves put together should be less than or equal to rupees 1 crore as on the balance sheet date. So even at a single day where there are this particular number has exceeded that particular 1 crore limit, then CARO reporting shall be applicable. It is on the balance sheet date is what that they have taken, but the point at the beginning of this particular applicability itself, which fulfills all the following conditions throughout the reporting period, is what that they have cautioned for. So one has to be carefully go and understand whether as on the balance sheet date, even if it is somewhat is less than that particular crore, there may be a buyback. So if at all during that particular year this condition has been not satisfied, then applicability shall be made mandatory here. And then the third condition is total borrowings from a bank or a financial institution should be less than or equal to rupees 1 crore at any point of time. So here again it goes similar to that of the original opening paragraph. At any point of time, the moment there is a number of borrowings has exceeded this particular 1 crore limit. So say for example, a company has bought a loan of 2 crores, and then they have repaid somewhere around for 1.5 crores they have repaid, and at the closing date they have only 50 lakhs in hand as a borrowing, but still CARO reporting shall be applicable because during any point of time this particular number has exceeded the limits here. And then the turnover as specified in Schedule 3 should be less than or equal to rupees 10 crores, which includes all the Schedule 3 income revenue to be considered here. So if all the conditions are satisfied, then for that particular private limited company, reporting under CARO will not be applicable. Auditor need not report on the CARO clauses. So with regard to consolidated financial statements, whether CARO will be applicable or not, there are 2 types. One is standalone financials and consolidated. So whatever the 143.11 that we are talking about is on standalone financials. With regard to consolidated financial statements, primarily CARO is not applicable except for one particular clause reporting, clause 321, which talks about all the negatives given for the subsidiary companies that alone to be incorporated. Otherwise, per se on the consolidated financial statement, the principal auditor who is going to report on the holding company's financial statement need not include on specified all other 20 clauses of CARO need not be reported here. So totally for CARO reporting, the paragraph 3 of this particular CARO reporting talks about 21 clauses. 21 clauses to be reported. Old CARO 2016 was 16 clauses, and now it is 21 clauses to be reported, which is divided into 7:7:7. My takeaway from the CARO 2020 is 7:7:7. What is the 7:7:7? 7 old clauses retained as it is, no change. 7 old classes with amendments, with inclusions that they have made. So amended classes is 7. And another 7 new classes have been reported, entirely fresh. So there are 21 classes to be reported. So 7:7:7 is the ratio in which the new reporting goes for the CARO by the statutory auditor here. Since the matter of importance, I will be focusing more on the 7 extremely new clauses that got included because a fresh reporting is to be made by the auditors, and then the priority will be on 7 amended classes. Previously there was the clause for reporting on PPE. Now also there is a clause for reporting on PPE. Previously there was a reporting on inventory. Now also there is a clause on reporting on inventory, but however which got amended. There are additional responsibilities have been loaded to the statutory auditors here. That particular carve-outs that we need to go for understanding. And the balance 7, the old clauses same verbatim retained as it is. The priority is somewhat very lesser. So I will be focusing more on these particular 2 perspectives, including the Schedule 3 amendments thereon. Let us go for the first clause to be reported, that is on PPE here, where as you can see the comparison, the yellow items marked are the new inclusions that got made in CARO 2020. As rightly started by Aditya sir right from the beginning of the slide, that which talk about PPE with regard to financial reporting, lot of problems and complications with regard to PPE here and also accounting as well as disclosures. This particular CARO 2020 makes certain specific responsibilities to the auditor. When we talk about finalizing an audit, I also give this particular important piece of information here, where SA 500, which talks about audit evidence, where I need to collect sufficient and appropriate audit evidence to form and express an opinion. First of all, I need to form an opinion, thereby I need to express an opinion here, where SA 705, 700 aspects are also being taken up by Aditya sir in an external confirmation matter of reporting. The point that I am driving here is, apart from expressing an opinion where I need to obtain sufficient appropriate audit evidences, parallelly, there are also specific clauses of CARO which wants the auditor to go for a specific verification and to obtain sufficient appropriate audit evidence in that particular regard, and then to give his opinion on this CARO or factual reporting is to happen. So I need to apply SA 500 also for all the clauses of this particular CARO reporting. I need to go and verify specifically. I need to go and verify, and I need to go and obtain sufficient appropriate audit evidence. I need to conclude, then only I may be in a position to report it in my audit reporting. So it is not no longer, it is never the copy paste of a previous report that may work out, that we don't do. But still, some of the point that I am driving here is where we need to educate our engagement staff, my audit assistants, who are actually doing the groundwork. I need to educate the importance of these particular changes, the workings that is to be done, the papers that is to be obtained, the documentation that is to be made, so that I'm having the comfortness in reporting. Because tomorrow there may be something like FRRB who will come and verify the accounting perspective. There is something called as quality review board. QRB will be going for a verification. Even NAFRA verification is also possible. So all for that, my only protection will be my documentation here. SA 500 read with SA 230 shall be the only shield that will be available for the auditor to ensure compliance of all the legal and regulatory requirements, including standards and 143 requirements here. Because Companies Act mandates 143 to be complied. If it is not complied, then there are penal provisions even under the Companies Act. So I need to have a holistic approach, 360-degree, and then I need to go for careful reporting here. Why this point is insisted under this particular clause? Because there is a specific question on immovable property with regard to its title deeds of that particular immovable property, whether it is in the name of the company. If not, then in whose name it is there, and the disclosure of the same is to be made. Without verifying the details, without going for the activity of taking out what are all the immovable properties that are held by the company, without verifying the title deeds of the same, the auditor cannot say anything in this particular regard. So it's mandatory for the auditor to go for a deeper verification, get a specific documentation, specific audit evidence, and then to go for giving the answers to this particular CARO clauses here. Previously, only PP have been included, where now the intangible assets are also part of this particular reporting. And then the new inclusions is with regard to the title deeds of all immovable property are disclosed in the financial statements, which are held in the name of the company or not. If not, that then there is a detailed details has to be provided for disclosure requirement. And apart from this, there are two new inclusions with regard to revaluation of this particular PPE, where whether the company has revalued its plant property equipment or intangible assets or both during the year, and if so, whether the revaluation is based on the valuation by a registered valuer. So there will be an external expert who will also be included in the work done by the management here. He will be treated as a management's expert whose work can be relied by the auditor, which can be used as an audit evidence. However, I need to apply certain three specific aspects: whether he is competent, whether this registered valuer is a competent person, what for the objectivity of this particular appointment, and also the estimates or the basis on which the working has been done by that particular management's expert has to be evaluated by the auditor, and then only I can accept the same as an audit evidence. When Aditya sir was talking about with regard to AS15 gratuity provisions, where there are actuarial certificates or actual reports have also been obtained, then in that particular case also I shall be applying SA 500 provisions, whether the management's expert work is acceptable as an audit evidence or not, and then to go for reporting accordingly here. Apart from it, there is one another clause with regard to Binami proceeding transactions here, whether any proceedings have been initiated or pending against the company for holding any Binami property under the Binami Transactions Prohibition Act. If so, whether the company has appropriately disclosed its details in its financial statement. So there is something like Binami property, where as a Binami Dar, where the company has involved in this particular litigation, there is a notice or there is a legal litigation that is pending in this particular case. then it will be the responsibility of the auditor to go and verify whether such case is there and whether the same has been properly disclosed by the entity or not. So this again makes a huge responsibility on the auditor. So this particular two aspects with regard to revaluation of its plant, property, equipment, and also on the Binami, in order to make the management also responsible, there is a Schedule 3 amendment that also got made here. I'll just come back for here, where reporting for revaluation and other adjustments are also been included in the Schedule 3 amendment. And not only that, with regard to details of immobile property also to be reported by the management in the Schedule 3, they got amended here. Whether the title deeds of all immobile property other than the properties where the companies, the lessee and the lease agreements are duly executed in favor of the lessee, recognized in the financial statements are held in the name of the company. So primarily, the management has to disclose the same, auditor has to assert that particular, validate the assertion, and then he has also to go for reporting under CARO here. If not, the following details shall be disclosed in the Schedule 3 in the specified format, where immobile property is jointly held with others, details are required to the extent that the company is having its own share, and those immobile property which is not held in the name of the company are also to be given here. Similarly, details of the Binami property are also to be included by the management itself in their Schedule 3 reporting, whether any proceedings have been initiated or pending against the company for holding any Binami property as defined under Prohibition of Binami Property Transactions Act. Then the details shall be details of such property, accounts, amount thereof, and details of beneficiaries, nature of the proceeding. Such particular data has to be provided for. Apart from the management providing this, it is the responsibility of the auditor to go for verifying that, because there will be something on application of SA 250 and also SA 501 to be applied here. SA 250, which talks about compliance of all applicable laws and regulations with regard to an entity, its impact on the financials, and SA 501, which talks about specific audit guidances on certain specific aspects, which includes litigations and claims. So this being a Binami property transaction where there are litigations and claims, I need to go and apply the specific procedures that have been discussed elaborately in SA 501, either to meet with the legal counsel or to meet the discussion with the in-house legal department, and then get the minutes of the meeting of the board, and then to go for conclusions in this particular regard here. So with regard to PP is concerned, this particular aspect are changed in the CARO 2020, where we need to focus more on such particular item here. Or the revaluation, where the management's expert aspect, we have discussed that. Binami transactions also, which is to be based on the written representation by the management also to be obtained, where SA 580 will also be applied by the auditor here. With regard to the second point of inventory, which was a very simple procedure previously, now they have made a huge responsibility to the auditor. Previously, you can just understand whether physical verification of inventory has been conducted at reasonable intervals by the management, whether any material discrepancies were noticed, if so, whether they have been properly dealt in the books of accounts. Only 3 points. So whether management has conducted physical verification, is there any material discrepancy, how it got adjusted in the books. That's it. But now when you go for the same inventory clause, whether physical verification of inventory has been conducted at reasonable intervals by the management, and whether in the opinion of the auditor, the coverage and procedures of such verification by the management is appropriate. So there is a huge ball that has been bowled to the auditor, that as for, based on my opinion, I need to go and comment about the coverage and procedure of such particular verification by the management. Not only coverage, but also the procedure. Is it appropriate or not? Which is a pure judgmental basis where I need to adopt. On what basis I'm concluding it is appropriate, on what basis I'm going to conclude that it is inappropriate, should also be substantiated by the auditor based on its documentation. Apart from it, and there are discrepancies, assuming whether there are any discrepancies of 10% or more in the aggregate of each class of inventory were noticed, is this third question here. The point is, previously whether material discrepancy have been noticed or not was the question, but now here whether the discrepancies is of 10% or more. So the materiality threshold is again given in the CARO clause itself. It is not based on the judgment of the auditor to go for it. With regard to materiality for inventory is concerned, for the purpose of reporting under this particular clause of CARO, the statement by itself makes it mandatory that 10% or more will be considered materiality, and then I need to go for disclosure of the same with regard to discrepancy of that particular each clause of inventory. and then whether they have been properly dealt in the books of accounts. Such material discrepancies that are identified by the management, which is more 10% in each class of inventory, has been properly adjusted in the books of accounts or not, to be specifically verified by the auditor. Again, while reporting under this particular clause 2, inventory where SA 501 will be applied, because SA 501 talks about specific procedures that are to be adopted by the auditor while finalizing inventory, including physical verification aspects of inventory and its valuation perspective, confirmation perspective are all discussed in SA 501. So careful aspects are to be applied by the auditor, documentation with regard to compliance of the standards as well. And not only that, there is an incremental load to the auditor by way of the bank statements that are submitted by the entity to the banks with regard to the borrowing facilities on account of the current assets. There is a new item that is to be reported by the auditor, whether during any point of time of the year, the company has sanctioned working capital limits in excess of rupees 5 crore. So any working capital limits in excess of 5 crore in aggregate from banks or financial institutions on the basis of security of current assets, whether the quarterly returns filed by the company with such banks or financial institutions are in agreement with the books of accounts of the company, if not, give the details thereof. So now the loading pressure to the auditor that whatever the stock statements that usually the management is used to submit to the bankers, say for example for DP calculation and all, usually it is a known practice, or it's prevalent in the market, that there will be some inflated numbers of the stocks that they will be providing for. And even though we do proper audit and we certify the financial statements, the bankers are no longer bothered about the audited financials vis-a-vis the stock statements provided by the management quarterly here. So in order to reconcile or not to catch hold of those discrepancies, now it's the responsibility of the auditor to look into whatever the statement that have been submitted to the banks vis-a-vis the items that you are going to certify. Is there any discrepancies? If it is so, the same has to be reported under CARO also. Whether quarterly returns statements submitted by the company to such banks or financial institutions are in agreement. If it is not in agreement, the details has to be given by the auditor here. So the point to be carefully noted is this reporting will be applicable only when there is a sanctioning of working capital limits in excess of 5 crores. So there could be a possibility, practically speaking, the limits may be fixed at 6 crores, but the company would have drawn only 4 crores. Whether still this particular reporting will be applicable or not, answer is yes. They don't talk about the actual borrowing. It is based on the sanctioned limits. So if it is 5 crore or less than that particular 5 crore, reporting under this clause will not be applicable. Otherwise, it will be applicable, which should be based on the current assets here. So careful. This is also added as a Schedule 3 reporting. The new question that they have added as a CARO is also a part of Schedule 3 reporting as an amendment here. The key points to be considered by the auditor here will be AS2 and Ind AS 2 with regard to classification of inventory, because we have a lot of classification. Inventory is always a subject matter of debate with its valuation, its accounting aspects, and its disclosure and all needs to be very carefully verified, because inventory plays a very vital component in the financial statements here, where the trend percentage of threshold limit with regard to materiality has also been applied here. And reporting on stock and data statement to be submitted to the bank with regard to DP, that is also to be taken care. The utilization may be less than the sanctioned limit of 5 crores, but such cases will also be covered for reporting. This is a specific guidance given by ICAI in its CARO guidance note. So we need to be careful on this. The meaning of the term sanction is to include fresh sanction during the year, as well as the limits renewed or due for renewal during the year. So this is not a fresh sanction, sir. Already it was there. I'm just only getting a renewal. So will it be treated as a sanction? Answer is yes, is what the guidance given by the institute here. Say for example, again here, April, May, June, 3 months I'm giving the monthly statements to the banker. In that particular case, the auditor's responsibility is not to go for all the months, but only for the quarters. For the return submitted on monthly basis, example for the month of April, May and June, the auditor would be required to verify the return statement solely for the month of June alone, being the relevant return at the end of the quarter, because CARO question is very specific on the quarterly aspects. So I don't bother about the April or May month, only those differences that are there in the quarterly risk that is to be reported under CARO here. This is what the Schedule 3 reporting. where I have given this as a background color so that you can understand these are all specific to Schedule 3 here. In case of company has borrowings from banks or financial institutions on the basis of security of current assets, it shall disclose the following, the same. Whatever the auditor is going to report shall be reported previously by the management by itself. The third clause is another most interesting and important clause. Careful aspects are to be applied. Even the same aspects have been touched by Aditya sir also with regard to loans, borrowings and all, where with regard to related party transactions reporting also. Similarly, here also there is an extended reporting that talks about whether during the year the company has made investments in or provided any guarantee or security or granted any loans or advances in the nature of loans secured or unsecured to the companies, firms, LLPs, or any other parties. So here, previously under CARO 2016, it was covered only for those parties covered under Section 189 of the Companies Act. But now it got wide open, not only for the firms, companies, or limited liability partnership in which my directors are interested, but to any other parties are also getting covered. So all the loans that are extended or the guarantees that are provided or the investments that are made by the companies needs to be very carefully identified. In one of the FRRB reporting, when you have, if at all you have carefully seen, there are certain loans that have been given without the repayment stipulation. There are loans that are given which are prejudicial to the interest of the company. There are loans that are given at rates that are much lesser than the market rates. So these data are not captured at all and not reported to the shareholders. So considering this particular aspect, they have made a lot of reporting aspects included under CARO 2020 now, where we need to bifurcate what are all the loans the company have provided in the nature of loans or stood guarantee with regard to company subsidiaries, joint ventures, or other associates and others. So like that, we need to go for a bifurcation. One is related party and the others, like that, we need to go for a bifurcated reporting with regard to loans provided by the entity and investments made, guarantees provided. All these are all the existing clauses of reporting. But the new clauses, this is something very, very important because many companies disclose the fact in such a way that they may give a loan to a related party, but they may not get the money back at all. They may not even stipulate that particular loan repayment period. They will simply specify that the loan has been provided which is repayable on demand. Like that, they will include a particular note. The moment a user of the financial statement reads this particular point, that there is a loan that have been provided that is repayable on demand, he will immediately assume that at any point of time the company can recall back the loan, and then instantaneously the other party shall be required to pay the loan. Is what the understanding, and then I'm quite happy. Very good. At any point of time they can call back, and then the amount will be coming back. Like that, I will be thinking it's good, but actually it is a not a right trade practice here, where on demand you cannot go in for, because being a related party transaction which is highly influential, there may not be any demand at all. So there should be a specific stipulation period in order to have a good corporate governance, in order to bring in those facts where there are loans that are provided which is without stipulating the repayment period or a schedule, is to be brought in and reported under CARO here. Whether any loan or advance in the nature of loan granted which was fallen during the year has been renewed or extended, or fresh loans have been granted to settle the overdues of existing loans given to the same parties. This is one another question. In a bank audit also, we used to verify with regard to NPA. Say for example, there is a due, there is a interest or principal due. Suddenly the banker may go and extend an ad hoc limit sanction, and then they may try to compensate this particular due. They will ensure that this particular loan is not slipping into an NPA criteria. So there will be, by way of a book entry, they will just compensate whatever the loans outstanding with the fresh loan here, which is basically prohibited by for a banking company. Similarly, here also the auditor has to look into whether where you have extended a loan which is falling due, but have you renewed it by way of giving a fresh loan instead of getting the repayment? If so, give that particular data so that the users of the financial statements may be aware that there is no actual cash repayment that's happening, but instead of my fresh loan, evergreen provision is happening, is what that they may be in a position to understand here. Whether they have been renewed or extended or fresh loans granted to settle the overdues of the existing loans to the same parties. If so, specify the aggregate amount of such dues renewed or extended or settled by fresh loans, and the percentage of the aggregate to the total loans or advances in the nature of loans has to be provided here. This is not applicable to those companies which are into lending business. The second question is what that I was talking about with regard to repayable on demand. whether the company has granted any loans or advances in the nature of loans, either repayable on demand or without specifying any terms or period. If so, specify the aggregate amount, percentage thereof, or to the total loans granted, aggregate amount of loans granted to promoters, related parties, as defined under 276. 276 talks about related party, including deemed relatives and all, are given under the Companies Act. So there will be a corporate governance will come into play while way of reporting. Care needs to be taken care by the auditor with regard to any of that particular loans that have been given. And also 143.1 reporting, is it prejudicial to the interest of the entity? Like that, there is 143.1 reporting that will be applicable. Here also the same has been included. Whether the investments made, guarantees provided, securities given, and the terms and conditions of the grant of all loans and advances in the nature of loans and guarantees provided are not prejudicial to the company's interest. So I need to be very careful in evaluating and reporting. Is it prejudicial? Is it properly secured? Is it the terms and conditions are at par with the arm's length price? And then to go for that particular conclusion to report under this particular clause here. So the coverage of the reporting has been extended to entire parties, not only confined to parties covered under section 189. Additional reporting with regard to group entities and its outstanding balances. Additional reporting by way of loans or advance in the nature of loan that are renewed just by way of a book entry. Additional reporting by way of loans or advances which are repayable on demand or without specifying any terms or period of repayment should also to be made by the auditor under CARO here. A party might have taken a loan or advance which is in the nature of loan from a company and repaid it during the financial year itself. Whether such reporting will also be applicable or not. While examining the loans, the auditor should also take into consideration those particular loans which got settled or squared off during the year also. There may be people who may be aware that at the balance sheet date, if at all I have a loan balance, then it may go for reporting. So let me close prior to that particular balance sheet date, like that they might have closed it. Still, there are reporting responsibilities applicable to the auditor here. This is what the change that got made in Schedule 3 here. Loans and advances to promoters, directors, and their relatives are to be reported here. Repayable on demand or without specifying any terms or period of repayment. If at all anything is given like that, the same has to be reported so as to understand its criteria here. These are all the same clauses to be reported, no change in respect of loans, investments, guarantees, and security. Whether provisions of section 185 and 186 of the companies have been complied with or not, same compliance here. Again, for deposits also, there is no major change that got made with regard to compliance of companies' acceptance rules and also RBI regulations or tribunal directions in this regard. In respect of deposits accepted by the company or amounts which are deemed to be deposits. So that alone they have included, not only deposits per se that I have received, for whatever the deposits that will be deemed to be deposits as per the Companies Act, whether the sections of 73 to 76 of the Companies Act, including RBI directions, have been complied with or not. This is a same reporting responsibility as that of the previous CARO 2016. So much of the change is not made here. So here, with regard to the auditor's perspective, what I need to do is with regard to examine the system by which the deposits are accepted and how it is repaid, how the complaints of 73 to 76 has been made by the entity are to be taken as a complaints procedure so that it will be applicable on SA 315 perspective also. Cost records, same item, no change. Whether the maintenance of cost records has been specified by the Central Government at 148, which talks about maintenance of cost accounting records, and also it talks about cost audit. Whether such accounts have been so made and maintained or not. So it's a prima facie verification by the auditor. The statutory auditor of the company need not go into a detailed verification with about the correctness of such cost accounting records, where I'm not going to do a cost audit, where mere maintenance of books and accounts as per 128 is also to be verified for this. With regard to undisputed statutory liabilities under clause 7 and disputed statutory liabilities under clause 7, which is a very important clause right from the beginning, even under CARO 2016, this is a important clause. Predominantly, every company will have its own reporting here. But they have included the GST also, because old law CARO 2016 doesn't have GST impact, which was introduced in 1717. So they have also included a statutory liability as a goods and services tax, where I need to report on the regularity of such particular payment, which are not disputed by the entity. If at all any dues are pending for a period of more than 6 months on the date of balance sheet, the same has to be reported by the auditor. Not only that, with regard to disputed statutory liability on account of a dispute, should also be reported under CARO 7, where the forum in which that particular item is pending, what is the amount that is pending, from which year onwards it is pending, is to be reported here, where care needs to be taken with regard to compliance of accounting standards, contingent liabilities, and also your 143 reporting requirements, that whether pending litigations have been, the impact of pending litigations have been properly accounted or disclosed in the financial statements or not. Like that, there is a specific question to the auditor which is to be looked into here. One of the important point that I would like to draw your attention here is where, as per the guidance note, the revised guidance note of ICAI, advance tax liabilities which are not paid will also be treated as an undisputed statutory liability, which is required for a reporting here. So we need to be very careful in ensuring that we are properly complying that reporting perspective here. The term other statutory dues covers all types of dues, various statutes. So only statutory dues are getting covered. Not every due will be getting covered. SA 250 to be applied, because to know whatever the various other statutes which creates a liability to the company, or whatever the dues that are payable by the company through other statutory laws and regulations, needs to be verified by the auditor, which includes dues to central, state, local, or foreign statutory dues are also to be considered as statutory dues only. Dues which are of a regular in nature, non-payment of advance tax will also be treated as a undisputed statutory liability. Municipal taxes and fee payable by licensing authority. On the other hand, for our information, these following items are not to be treated as a statutory liability. Those which are levied on time to time on occurrence or non-occurrence of a particular event, or dues of a contractual obligation, even electricity dues. Electricity dues will not be treated as a statutory due. Even though it is paid to a statutory authority, the due is not through the statutory, so it is not considered. Even payment of bonus. Sir, statutorily I need to discharge my bonus. Yes, but it is not paid to the statute. It is only paid to employees, will not be treated as a statutory due for the purpose of reporting under clause 7 of CARO 20 here. Dividend payment at all will be out of a contractual obligation. Since it is of a contractual obligation, it will not be treated as a statutory due here. Another very important clause, financial discipline. To depict the financial discipline of the company, this particular clause has been included for reporting. Lot of new items are to be reported by the auditor. Very careful analysis to be made. Parallel Schedule 3 amendments also got made, but still the responsibility is casted to the auditor here. Whether the company has defaulted in repayment of loans, even repayment of loans, Aditya sir was talking about financial reporting, they have not specified. They have to bifurcate what's the principal, what's the interest component, like that. They have not done it cumulatively at a holistic number they have given, which is wrong. So here also, whether the company has defaulted in repayment of loans or other borrowings, in the payment of interest thereon to the lender, if yes, I need to give the breakup of the same with regard to the provided format here. Here, the role of SA 505 will come and operate with regard to external confirmation, where the auditor may be seeking external confirmation to those parties which have given loans, the borrower or the lenders were given, and the company is the borrowing authority, where we can go and verify whether the prompt repayment have been taken as per the contractual agreement or not. And next questions are all new items. Whether the company is declared a willful defaulter by any bank or financial institution or other lender. Again, while getting a bank confirmation, where say for example, banker has extended me a loan of 10 crores, and then I need to get a bank confirmation, I may also include this particular question under my confirmation letter by the auditor, where the management is sending the confirmation letter. Auditor may ask the management to include it, whether the company has been declared as a willful defaulter. So let the banker, who is the confirming party, confirm that we have not classified, or yes, we have classified like that, so that we will have the right information with us. Whether the term loans were applied for the purpose for which the loans have been applied. It is nothing but an end use of borrowing that I have to evaluate. So I might have applied a term loan for a particular purpose, whether the same has been utilized or I am using it for a different purpose. If at all the auditor comes to know that it has been used for a different purpose rather than the specified purpose, that itself will be an indicator that there are certain financial constraints, financial strains are there, or the financial indiscipline is also there. Maybe a short-term financial crunch to the entity. I need to go for immediate application of my SA 570 with regard to going concern. Is it to be treated as a material uncertainty? Is it a yardstick for evaluating the financial prudence of the entity or not? Like that, the auditor's professional skepticism will be automatically start working, and then I need to get evidence accordingly here. Whether funds raised on short-term basis have been utilized for long-term purposes. Again, a square case of short-term funding has been used for long-term purposes. If yes, the nature and amount to be indicated. So the auditor has to very rightly classify what are all the amounts that you have obtained for what purpose it has been used for. So I need to track it. Unless I verify, I may not be in a position to track it. So I need to go and have a detailed audit procedures, and I need to go for an audit in depth, so that from the head to tail, I may be in a position to map where the amount is used for, and whether reporting under CARO will be applicable or not. Whether the company has taken any funds from any entity or person on account or to meet the obligations of its subsidiaries or sister entities. If so, the details of it. For my sister concern, I have borrowed the money and then I have used for that purpose. Or whether the company has raised loans during the year on the pledge of securities held in its subsidiary, joint ventures, or other associate entities. If so, the fact has to be brought in here. With regard to caution to be taken by the auditor for willful default, the auditor has to be very rightly understanding what do you mean by willful default. It's not a default. Every default need not be treated as a willful default. Again, willful defaulter has to be classified by the banker, by the appropriate authority. Then only reporting under this particular clause will be applicable. Say, for example, intentional, deliberate, and calculated financial indiscipline should have taken place, like diversion of funds, siphoning of funds, or sale of fixed assets without the lender's knowledge, where I have hypothecated, or capacity to repay is there, but I don't repay, I don't repay here. All may be a criteria for classifying a particular borrower as a willful defaulter here. So I need to also apply the case of SA 560 also. As on the date of balance sheet, he has not declared as a willful defaulter, sir. But after, subsequent to the balance sheet date, a particular banker is notifying the borrower as the entity as a willful defaulter. Should I need to consider? The management contends that you are as an auditor to report as on the financial statement date. As on the financial statement date, no problem. So don't report is what the contention of the management. What I have to do? I need to exactly apply SA 560 here, where events, subsequent events, or events occurring after balance sheet date as an accounting standard. Similarly, standards on auditing also talks about SA 560, which talks about subsequent events. As per SA 700, at the time of my report, my audit report signing, even though I am signing as on the financial statement date, whatever the considerations, whatever the points are to be considered up to the date of my signing has to be done. It gives a deeming notification, deeming notion that I have considered all those accounting aspects that are up to the date of signing, and then I am signing. That's what the notion, that's what the premise on which SA 700 signing is happening. Similarly, SA 560 also talks about subsequent events, where this will be squarely falling under an adjusting item. The auditor needs to go for reporting this particular aspect also, even though as on the financial statement date, he was not a willful defaulter. But subsequently, if that particular portion is declared, then I need to necessarily consider in my reporting, and even my opinion could be changed in this particular regard. The integrity of the management, the evaluation of the financial statements by itself will have a U-turn if at all these things occurs. So this is what Schedule 3 change that got made. The company by itself on its own has to declare where a company is declared a willful defaulter by any bank, financial institution, or other lender. Following details shall be given: date of declaration as willful defaulter, details of defaults. Willful defaulter here means a person or an issuer who is categorized as a willful defaulter by the bank or a financial institution as under the Companies Act, or consortium thereof, in accordance with the guidelines on willful defaulters issued by RBI here. Raising of funds with regard to initial public offer or further offer, all are same aspects as that of the previous one. Whether money is raised by way of IPO or further public offer, including debt instruments during the year, were applied for the purpose of for which it has been raised. It's nothing but end use of the borrowing, the disclosures, the aspects relating to the raising of the particular funds. If not, the details together with the delays of default and subsequent rectification made shall also to be reported here. Fraud reporting, caution. Please understand, this is again an increased reporting that happens. Fraud reporting, fraud always a litigative point from the auditor. Auditor is always a watchdog and not a bloodhound. Even there are certain views from NAFRA that the auditor should be made responsible for detecting frauds. That can never happen. That will not happen because my objective by itself is different. Fraud detection is none of the duty of the auditor. That doesn't mean that the auditor will not detect frauds. Certainly, yes, but that is not the objective of the audit here. Even Companies Act 143(12), there is a specific aspect of fraud reporting with regard to material frauds of rupees 1 crore or more has to be reported to the entity, audit committee, and also to the central government, and there are reporting responsibilities. Here also, CARO, there is a specific question. Clause 11 talks about it. There is a minor change that got made. Whether any fraud by the company or fraud on the company has been noticed or reported during the year. So it is those frauds that are noticed or those frauds that are reported to the auditor has to be disclosed here under this particular clause. Very careful pointers. Under 143(12), I will be reporting on frauds on the company. However, under CARO, there is a responsibility to report both the frauds, that is frauds on the company as well as frauds by the company here. So auditor has to be very careful in getting the information about it and then to go for reporting frauds, whether any fraud by the company or any fraud on the company has been noticed or reported. If so, the nature of the amount involved should also be reported by the auditor. And incidentally, 143(12) compliance and the LODR compliance is also talked about here. Whether any report under 143(12) of the Companies Act have been filed by the auditors in form ADT4. ADT4 is the form through which the normal frauds under 143(12), which are rupees 1 crore or more, which is to be immediately to be reported to the central government and also to the management. Actually, the fraud reporting under 143(12) course by itself is different. I need to report to the management first, to the audit committee if any, and then wait for 45 days to get the responses of the audit committee. If the audit committee has responded back, and then pack it along with that, you need to apply it in ADT4, provide the data to the department or to the MCA. On the other hand, when the board has not acted anything about the report that you have submitted on account of fraud, still wait for 45 days and then to report on your own about that particular fraud to the central government. So that filing will be happening in ADT4. The same responsibility shall be applicable for a cost accountant who is doing a cost audit. Same responsibility will also be applicable to a company secretary who is doing a secretarial audit with regard to frauds reporting. There is a penalty also that will be applicable as per that clause. So whether any such reporting has been happening, if so, the detail is to be provided by the auditor here. Apart from it, whether the auditor has considered the whistleblower complaints. Nothing but section 177 that talks about audit committee, where even LODR regulation talks about vigil mechanism, whistleblower mechanism has to be installed so that a person who is making a complaint can even have a direct access to the audit committee chairman. So whether the company has received any of such particular whistleblower complaints, if so, whether the auditor has looked into and then reporting shall apply here. Whether the auditor has considered whistleblower complaints, if any, received during the year by the company. See, unless the company intimates to me that there is a whistleblower complaint, the auditor may not come to know about it at all. So I need to get a management's representation, SA 580. I need to go and verify the minutes of the particular audit committee meeting which has discussed this particular whistleblower complaints, and then only I may be in a position to go for reporting accordingly here. Even though there is a corporate governance certification that will be done by the management, it is the audit procedures that are separately to be performed by the auditor in consonance with LODR regulations for listed entities here. Now, this is all the changes with regard to frauds. The key point to be considered is whistleblower complaints received during the year shall be considered by the auditor. The auditor is not required to consider whistleblower complaints pertaining to earlier years while reporting under this particular clause. SA 240 to be applied. The moment you think of fraud, immediately our mind should go and apply SA 240, which very categorically talks about professional skepticism, the roles and audit procedures to be employed by the auditor while performing audit of financial statement, and their role on frauds is also reported here. Managerial remuneration clause, originally which was reported under CARO, now shifted. No more reporting under this because 143(3) reporting itself, managerial remuneration has been included as a part of 197. Whether managerial remuneration has been in accordance with 197 Schedule 5 has been rightly complied with or not to be reported. Again, this will be a very rare reporting, only applicable to a Nidhi company here. Same reporting as that of the previous. One extra clause that is reported is whether there has been any default in payment of interest on deposits or repayment thereof for any period. If so, the details has to be provided. Apart from your NO of ratio criteria and unencumbered term deposits has to be reported by the auditor. Related party transactions, squarely you need to apply your accounting standards along with SA 550. where same, there is no change with regard to the compliance 177-188 of the Companies Act disclosures to be made. No change with regard to this CARO reporting. But however, as an auditor, I need to go and apply with SA 550, which talks about related party transactions. 3 important points to be noted: identification of related party transactions, accounting of such related party transactions, and disclosure of such related party transaction, whether it has been appropriately made or not. So the auditor, whatever the points that was discussed in FRRP reporting with regard to related party transactions, same will also apply here for reporting by the auditor. And then allotment of shares with regard to preferential allotment and private placements, all same here. Whether the company has made any preferential allotment or private placement of shares or convertible debentures, whether the compliance of Companies Act have been made or not, requisite approvals have been made or not, whether whatever the funds that has raised by way of private placement or preferential allotment, whether the purpose have been utilized, that is end use of borrowings, is one second question, which is the same point as that of the previous CARO here. Non-cash transactions with regard to directors and the parties in which directors are interested is also the same. So there is no such amendment that got made. So I'm focusing more on the next one. With regard to RBI registration, there are furthermore questions that they have asked for. Complaints of an NBFC here, whether the company is required to register under Section 45IE of the Reserve Bank of India Act. So if so, whether registration has been properly obtained or not. This was the same question, no change. But however, they have included further questions, whether the company has conducted any non-banking financial or housing financial activities. Previously, housing financial activities was not under the RBI control. Now, housing finance activities is also under RBI control. Whether certificate of registration as per RBI has been obtained or not is the first question. And the second one is on core investment company. Whether the company is a core investment company as defined under the Reserve Bank of India, because core investment company with regard to its assets portfolio and also your investments portfolios shall be within the group only. So whether have you classified as a core investment company? If so, there are systematically important and others where you need to go for a mandatory registration or not. So whether are you still exempted, like that, there are questions to be reported here. If so, whether it continues to fulfill the criteria as an exempted core investment company. RBI gives a detailed deliberations in this particular regard. What are all the companies that are getting exempted and when you need to go for a registration here. Apart from it, one another question, whether the group has more than one CIC, core investment company, as a part of the group. If yes, indicate the number of CICs with that part of the group. Only numbers. How many group companies with the CICs is to be reported here. This is again to be reported by every company, not only for an NBFC company to be reported. All companies, whether in that particular group, whether any one of that particular group entity is to be treated as a CIC or not, to be reported here. Again, the term group is very wide, which is not specifically defined in this particular clause. But however, the guidance note on CARO very categorically says the term group doesn't mean that you need to go and apply your Companies Act here. You need to go and apply your RBI directions in this particular regard. Companies in the group has been specifically defined under the RBI directions, which the same definition shall be applicable here. Apart from it, the new clauses for reporting where undisclosed income with regard to income tax, that previously there is an undisclosed income and now you are offering that particular disclosed to the department, the same has to be reported here as per the Income Tax Act. Whether any transactions not recorded in the books of accounts have been surrendered or disclosed as income during the current year, current income tax assessment. If so, whether previously unrecorded income has been properly recorded in the books of accounts during the current year or not is the question here. Again, same reporting will also be applicable under Schedule 3. So these are all very tricky questions to be reported. So the management's responsibility is also equally included there. The company shall give details of any transaction not recorded earlier in the books but now offered as an income. And it's not out of an assessment that there is a demand and you are now paying. That's not the case. But voluntarily that you have surrendered or disclosed that particular item as an income, then that particular undisclosed income as per Income Tax Act shall be applicable for reporting under this particular clause. Section 131 of the Companies Act is also to be considered, where there is a voluntary revision of books of accounts that is also be possible, wherever there are changes to be made, where voluntarily the board of directors report or in the finance statements, where you can go for 131 operations also. That is, even after finalizing the finance statements, you can go for a revision of financial statements. 130 talks about mandatory reopening of books of accounts by regulator. 131 talks about voluntary revision by the entity. Again, a beautiful clause, really a worth clause that have been included under this particular CARO is about internal audit system. Whether the company has an internal audit system commensurate with the size and nature of its business. The auditor has to apply its judgment according to the size and nature of the business, whether the internal audit system which are required to be there, whether which are presently there, is it commensurate to it or not, to be examined by the auditor and to be reported. There is also section 138 of the Companies Act that talks about mandatory internal audit for certain entities. So whether you are falling under that particular criteria, if so, whether you have an internal audit system or not, whether or not 138 is applicable, where for a particular entity, internal audit or internal controls are considered to be the back spine of every entity. The SA 315, while discussing how to evaluate that particular entity and its environment, including its internal controls, clearly talks about internal control evaluation here. Being a part of the integral part of financial reporting, auditor should also verify whether the company's internal audit system is commensurate to the size and nature of its business, whether reports of the internal auditor for the period under audit were also considered by the statutory auditor or not. Where SA 610 will also be applied here, where there is a use of an internal auditor's work. So the auditor has to apply SA 315, SA 610 in this particular regard, and also wherever you talk about the internal audit system, there will be 143 reporting with regard to internal financial controls with reference to financial statements shall also be included for the purpose of the reporting under this particular clause. Very important clause, carefully the auditor has to look into. If at all, assuming that the management is not presenting that internal audit reports to the auditor, that may be tantamounting to restriction in the scope of audit. In such a case, that I may even go for a disclaimer. It may be treated as a restriction where I may even report as per 260, may be treated as a key audit matter, or I may even modify my report accordingly if at all it's considered to be material and pervasive effect. Cash loss, which is another new clause to be reported, which was not previously there. But before CARO 2016, I think in CARO 2003, we had this particular sort of reporting here, whether the company has incurred cash losses in the financial year and in the immediately preceding financial year. So there is a cumulative condition is what the question in the current year as well as in the immediately preceding financial year, whether there was a cash loss or not is the question here. In that particular regard, cash loss need not be obtained only through the cash flow statement here, because it takes through operating activities. However, it may be appropriate to consider such cash flows for the specific and limited purpose of this clause, considering the items as interest income, interest expenses and all may not be there in the operating part. So I need to go for all those adjustments that are not having here to identify that particular cash loss. Again, another interesting aspect is cash loss in one particular year, not on the other year. Maybe in the previous year cash loss, current year no cash loss. Current year cash loss, previous year no cash loss, like that. There could be a situation. In such a case, the guidance note gives the provision that it is better to report the fact, so that even in one of the year there is a cash loss, you need to report the fact is what the guidance provided by ICAI here. A situation may be there where the company has suffered cash loss in any one of the years referred here. Then the auditor is well advised to comment on 2 years separately. The current year, though there is a cash loss in the current year, previous year there was no cash loss, like that. I need to specify the fact as it is. Shall I take another 5 minutes more so that I can go for another 2 classes?
Yes, sir. Please.
So CARO and Schedule 3 amendments is in such a way that it cannot be compressed within 1 hour. But Aditya sir has rightly done that. But it takes time for me to go for it because a lot of deliberations to happen.
Yes.
With regard to resignation of auditors also, where there is a specific provision under the Companies Act where I need to go and file ADT3 within 30 days time, which creates a casual vacancy, the reason for such resignation has to be reported. So here also, whether there has been any resignation of the statutory auditors during the year, because maybe I may be an incoming auditor reporting for the purpose of financial statement, but previously there may be an auditor who might have resigned. And then there is also professional ethics will also apply, where I need to communicate to the previous auditor, consider his comments, and then to take up, I need to evaluate whether my appointment is valid or not as per the professional ethics. So all these to be complied, and then I need to report accordingly. If so, whether the auditor has taken into consideration the issues, objections, or concerns raised by the outgoing auditor. In order to protect and independence of that particular outgoing auditor, this particular specific question has been included under CARO, so that reporting to the shareholders can be made here. There is also a similar change that got, not a similar change, that there is a caution that has made in SA 210 with regard to SEBI guidelines also. Say, for example, I have done a limited review of 3 quarters, and then now I am resigning in the 4th quarter. SEBI has advised that you need to go for performing the 4th quarter also, and then only you can go for resignation like that. There are conditions to be included under the engagement letter itself, like that they have given a circular here. Another most important clause, again debated clause, is something on this material uncertainty, which is to be taken in the background of SA 570, especially under COVID situation about going concern here. This clause is more responsive clause for the auditors on the basis of financial ratios, aging, and expected dates of realization of financial assets and payment of financial liabilities, other information accompanying the financial statements, the auditor's knowledge of board of directors, and the auditor's knowledge of management plans, whether the auditor is of the opinion that no material uncertainty exists on the date of the audit, that the company is capable of meeting its liabilities as and when they fall due within a period of 1 year from the date of balance sheet. Like that, there is a huge question, responsibility has to put on the auditor, that based on your various factors, you tell me whether the company will be capable. Is there any material uncertainty that the company may not be in a position to pay its dues, all its liabilities which are falling within a particular period of 1 year's time? Usually the going concern perspective will also be for a period of 12 months. Here also the same yardstick has been taken out here. Again, will be a huge responsibility, but fortunately Schedule 3 also got amended to include this particular aspect here. What do you mean by material uncertainty? Material uncertainty normally for the purpose of CARO, for the purpose of SA 570 shall be, even for Ind AS has defined material uncertainty accordingly, means that those uncertainties relating to events or conditions which may cause significant doubt on the entity's ability to continue as a going concern, where there is a necessity for shutting down your operations. So in such a case, material uncertainty available, then the reporting perspective by itself will get changed. You need to apply SA 570, SA 700, 705, like that a combo will be applicable in that particular case. However, reporting under CARO will be restricted or confined only to meet out its liabilities which are going to be fall within a period of 1 year. Again, one cannot go for a wrong assumption that it is only for current liabilities that we are talking about. No, current liabilities will be based on the operating cycle of that particular entity. But here, whatever the dues that are falling within a period of 1 year has to be evaluated, and the ability of the entity to meet out its liability should be rightly assessed by the auditor, rightly evaluate the management's plans in this particular regard. And I need to go for reporting under this particular clause here. I need to necessarily consider the effect of SA 570 as well as 700 here. This is with regard to 570, wherever there are material uncertainty. Even before this particular commencement of meeting, where I was discussing with Aditya sir with regard to material uncertainty, which was not reported, mandately the moment there is a material uncertainty while doing an audit of finance statement, irrespective of the fact whether it is having an effect on going concern or not, still the same has to be reported by the auditor in his auditor's report under the separate heading called material uncertainty related to going concern. Even though going concern could not be affected, but still I have to report it. Even management has to report the same under their notes. If they have not done so, then I cannot even go for a clean opinion. I need to go and necessarily I need to provide a modified opinion because of the fact that the material uncertainty has not been disclosed by the management, which itself is a significant matter to be reported here. And when the going concern is affected, then I may not be in a position to provide any other opinion other than adverse opinion. When going concern base of accounting by itself is not valid, but the finance statements have been prepared on the basis of going concern, the auditor shall provide only adverse opinion, no other option. So all these aspects needs to be considered carefully by the auditor with regard to going concern here. Disclosure are also made for evaluating criteria like current ratio, debt equity ratio, and all for analytical purposes, analytical procedures application. Schedule 3 also got amended to include these aspects. And lastly, CSR reporting, section 135 of the Companies Act, where we divided into two. One is other than ongoing projects, and the other one is amount not spent with regard to ongoing project. With regard to anything other than ongoing project, so I need to transfer it to a fund that is under Schedule 7 of the Companies Act. There is a time limit of 6 months. If at all I have not done it, the same has to be reported. On the other hand, if it is on account of an ongoing project, then I need to go for a separate bank account within a period of 30 days timeline. If at all I don't do it, the same has to be reported here. So ongoing and other than ongoing, like that, they have classified. And last class is CARO with regard to consolidated financial statements. In consolidated financial statement, any of the negative reporting that is done by the component financial auditors, where the other auditors, technically called as per SC 600, where the other auditors have given any negative remark in any of the clause under CARO, the same has to be consolidated, and the consolidating auditor, the principal auditor, has to just indicate what are all the company and what are all the clauses in which there is a negative remarking done by the component auditor has to be reported. I need not specify what are all such negative qualifications. Just to indicate the numbers of that particular clauses is sufficient, is what the guidance provided by guidance note here. That's it. Within a period of 1 hour's time that we may be in a position to squeeze with regard to CARO. CARO is such a wonderful ocean that we can swim all along. And I personally thank the organizers, Chankalpattu branch SIRC, for organizing this wonderful session within a short time and in a right manner. And also thank my co-speaker Aditya sir for sharing his wonderful knowledge, and the dear participants without whom it would not be possible. Thanks for your motivation. And finally, to the Institute for providing me this wonderful opportunity to share whatever that we learn with our professional fraternity. Thank you.
Thank you, Balaji. It was indeed a really wonderful session, and I do agree 1 hour is not enough for the topics we have covered. In fact, you have touched right from the basics of CARO, from its applicability till the comparison of 2016 and versus 2020, and the detailed analysis of each and every clause. We're really thankful to you. I'm sure the members would have benefited out of this. We now move on to the question and answer session. We have a couple of questions which have been posted here. Can I start with each of them?
Yes, madam.
I will go ahead reading them. So based on the questions, you can answer these. So we have a question from CA Srinivasan Lakshmi Narasimhan. 90% of companies do not do actuarial valuation of gratuity or leave compensation. In such case, what else can be given under AS 15 except to state the facts?
90% of the companies, I don't know from where that number comes from, but then according to me, the accounting standard does not say that you should not have. Actuarial valuation report is a must if you have a gratuity. And again, for leave compensation, unless it's a short-term leave, you don't need it. But if it's a long-term benefit, definitely the actuarial valuation would be required. I can add certain point to it that many companies take a stand that since I take, say, for example, a statement from LIC, that will be enough. But the standard is very clear that it should be from an independent actuary. So they have to take an actuarial valuation report and then provide for the liability or the provision as indicated in the by the actuary. So my answer is we have no other option but to take an actuarial valuation report.
Okay.
Balaji sir, if you have a different view,
Yes,
you can,
no. I agree with you, sir. I go with that. In order to answer this specific question, what to be done, then in that particular case, you need to apply SA 705 considering the materiality perspective. A clean opinion should not be possible if at all it's material, and then I need to treat accordingly. I go with you, sir. Correct.
Yes, madam. Next question.
Okay. So there's another question by CA Murari. How to disclose fixed deposits under bank lien?
Fixed deposits under bank lien, you will have to show it as a separate line item under bank balances, but then that portion will not be considered in cash and cash equivalents. So to that extent, there is a gap. That gap will have to be explained in the form of a reconciliation.
And sir, do we can we also give the under secured portion of loans, the nature of security? So under that, can we also provide the specific point?
No,
with respect to the FD?
So those are all structures which is given in Schedule 3. You simply have to follow that Schedule 3 structure. That's it. Okay,
fine. We have a lot of questions on sharing the PPT. I'm sure it will be shared.
Yeah, we will give it.
The speaker.
We'll share it to the institute. Possibly you can disseminate all of it.
It will be done.
Sure. We have another question from CA Srinivasan. With regard to private placement, etc., of shares, reporting in CARO, does it include all allotments made during the year, even by a private limited company, whether it applies if the private limited company has allotted shares to existing shareholders only, or it has allotted to other persons?
Every allotment will have, anyway, this particular disclosure will be happening in the changes in statement of equity, where there is a allotment of shares that's happening. Anyway, that particular disclosure will be getting covered. Under CARO specifically, from the auditor's perspective, I need to look into its utility, that is its compliance, and also the end use of that particular borrowing, and report accordingly.
Sir, if I may add here.
Yeah.
I think that there has to be a distinction made between private placement, preferential allotment, and rights issue.
Yeah, with regard to disclosures.
Yeah, the rights issue, to my knowledge, is not covered here.
No, rights issues is not included. Private placement and preferential allotment have been correct. Yes. But anyway, even a rights issue, but Schedule 3 requirement will want that particular disclosure also to be
correct. Correct.
Okay.
Yes.
We have another question from C.S. Subramania Iyer. Receipt of amounts in the nature of loans. The question is incomplete. This is what he states. Receipt of, probably he wants to know the disclosures with regard to receipt of amounts in the nature of loans. So,
when CARO, maybe I can understand that with regard to CARO reporting, it doesn't talk about the amounts that you got. It only talks about the amount that you have lent for. So maybe if at all anything that you have, the company has borrowed for, whether any CARO reporting, maybe that could be the instinct in which the question has been drafted, is what that my assumption. No such reporting specifically with regard to receipts of amount. It talks about the loans obtained and its repayment and the compliance with regard to financials and all. That it is there.
Okay. There are a couple of other questions with respect to investments. In fact, when C. Aditya was discussing, we had an information on that. We'll have to value each and every investment specifically. So it should not be on overall basis. So can you elaborate on that, whether category-wise disclosure and each and individual investment has to be done with respect to the valuation or the overall basis?
No, investments have to be valued based on what type of instrument it is. Is it equity, preference share, bond? So it goes by the nature of investment. One. Even AS30 talks about valuation based on the category wise, not on a global basis. Even under Ind AS, as and when they make the investment, they need to ensure whether this is to be fair value to P&L or fair value to OCI if it is an equity. And once they make that choice of OCI for an equity instrument, it is an irrevocable decision. So there are a lot of management decisions involved when doing the accounting also.
Okay. With respect to investments in subsidiaries, we had a point in discussion with respect to companies which turn bankrupt in the subsequent years, or we go into IBCs. So how is it really possible? Because nowadays there are a lot of IBC cases coming up, so which really turns into IBC cases very soon. So in that respect, how do we really take care of the disclosure aspects? So the previous year probably the valuation would have been good, and the subsequent years there are such reportings.
So that comes through the quality of disclosure and substantiating. See, it cannot come into IBC just like that. It would have taken some amount of time to come to such a level that you need that major operation. So I'm sure that sickness would have been there for quite some time. It's just that it was noted but not disclosed. So even if I take a case of theoretically saying that, okay, last year it sounded good, but all of a sudden this has turned bad, then the only way is to substantiate what transpired between last year to this year, wherein what I thought was a good investment has turned out to be a bad investment. That comes with the quality of disclosure that you give.
So it is always safe for us to give a proper material disclosure.
Yes, disclosures are extremely important.
True. add to Aditya's point in this regard, in order to protect from the auditor's perspective, I only see from the protection of the auditor. To protect myself where there are assumptions or there are huge adjustments that are to be made or judgments are to be made, then in that particular case, reporting under SA 701 shall also be fairly a better way of reporting, where SA 701 as a key audit matter will never be considered as a qualification or getting out of my responsibility. It is just out of the matters that I have communicated to the management, which is of most significance, which I feel that is to be brought into the knowledge of the shareholders as well. As he was talking about a prudent, good corporate governance, it will be good from the auditor's perspective also to put that particular aspect, which involves complex valuation and complex factors. I may put it under SA 701 and also to give what are all the procedures that is specifically taken by the auditor in ensuring that that particular amount has been rightly stated can be elaborated so that I am at least protected to that particular extent, which is really complex.
Just to add, madam, see, why would FIR would have also brought out this? This is just my guess, sir. Typically, if it's a listed company, you also do a quarterly review of that. So it is just not that from 1 year you're just seeing the finance of the subsidiary company only in the next financial year. You would have got an opportunity to review it quarterly. If that was the case, it should have shown up in one of the reviews at least.
Okay. There was also one more instance in your slide where we had the confirmation received for receivables or advances. So there are circumstances where they have not received at all, or at least a partial receipt of these confirmations. So how do we handle these two situations separately?
The experience of getting confirmations, I know it will be difficult because sometimes they don't respond. In that case, we would also have to look into the post-balance sheet events. Against this money that is outstanding, how much would have been received? So you have an alternative evidence to at least see whether that receivable existed on that particular day. Because again, even in the standard, it says once you send a confirmation, you have to do a reminder. You have to follow up once or twice. But despite that, if nothing comes up, you only have an option to see post-balance sheet what has happened to that amount, and keep a document of it. Under the standards, you keep a document that on this day we had sent out the confirmations, on this day we had done a follow-up, there is no response to it, then what was the action taken?
Okay, but
Madam, very good question to add, Aditya Sarpanch. That was a beautiful observation by FRRB, and the comment is also very rightly has been drafted here. I can just give a share for academic purpose. Listed companies' financial statement, which exactly on this particular point, they have modified their opinion. This is the listed company, just for academic purpose, not to find anything. The company's trade receivables are subject to confirmation as of 31st March. The possible effects of the same on the assets and liabilities or profit, if any, is not ascertainable. So I feel that I don't have a sufficient appropriate audit evidence, but I feel that it is material but not pervasive. Then in that particular case, I go for a qualified opinion. I cannot go with a clean opinion. I go with a modified opinion is what the listed companies auditors view, which is absolutely right, because I cannot just like that put a note that it is subject to confirmation and then get out. So that if someone asks the question that I have already given a note, that is for no purpose. That doesn't serve any purpose. It just increases the curiosity of the users of the financial statement, what the auditor is trying to conclude based on that particular note. So this is what the right treatment is on this particular matter. SA 505 also is very specific. They go and again, confirmation is not the only approach through which you need to get an audit evidence. It's not a mandatory perspective, but that's a very important tool that is available for the auditor to go for it. There are alternative methods available. If it is not, the means are not sufficient, you go with the confirmation, and this will be the treatment.
Right, sir. Perfect. In fact, for under revenue recognition, AS9, we had a discussion where there are certain circumstances, upfront recognition of revenue is required, or it is not required. So where are the circumstances where it is required and generally it is not followed?
No, once you draft an accounting policy, it is that what conveys whether you are recognizing the revenue upfront or otherwise. Technically, under AS9, you will recognize revenue where the risk and rewards have been transferred there is no significant uncertainty on the realization of those views. Primarily, these two conditions have to be met. There could be, for example, companies say I render a service over a period of 2 years, I receive the money. Technically, that revenue should be recognized over a period of 2 years. But if I recognize it in day one, I'm upfront recognizing the revenue, which is incorrect.
Okay.
Whereas if you look at India's 115, it is a lot more complex in terms of establishing the 5 steps, then identifying what are the obligations. So at least in AS9, you have limited condition, but in AS 115, it is all the more complicated.
Okay. With respect to related parties under AS19, so is it enough we provide under the notes to accounts the details of to be prescribed under AS18, the disclosure? Is that enough, or is there any other further disclosure which is required?
The disclosure of related parties under AS18 is always under the notes to accounts. So typically it will have the first section where you mention these are the list of related parties and how are they related. KMP or director or subsidiary company, associate, like this you will list. In the second section comes what are the transactions with the related parties. So there again you list the name of the companies or the person. Then what is the transaction, purchases, sales, loan, etc. What is the transaction during this year and what is the transaction in the previous year. And
the balance is outstanding in the as at the end of the period.
As at the end of the year, yes.
Right. So that would do.
1 or 2 cases where the company may not have that information. For example, if you take the managerial remuneration to be disclosed, a managerial remuneration, they may have the details of short-term benefits like the salary, what they're paying, long-term benefits, etc. But when it comes to gratuity, for example, the actuary will not be giving you a separate breakup only for the KMP. In those cases, I have seen companies giving it as a note saying that actuarial valuation is taken for the company as a whole and no specific information is available to the KMP as such. So that note has to be given. Otherwise, I think that there is no gratuity given.
Under Schedule 3, we had discussions on willful defaulters. So as such, it is specifically not been defined under Schedule 3. What do we really take it as when we are going to go for audit now?
Madam, the guidance by ICAI is very clear in this particular regard, how to treat a person as a willful defaulter. It is not at the judgment of the auditor whether he is a willful defaulter or not. No, it's basically a notification by the banker or a lender in accordance with the RBI directions they need to go in for. We can go for the public domain so that to have the confirmation. That's what I told you. And when during the discussion, when we send a confirmation letter to the bankers or the lenders, we can also add a question whether there is a specific classification of a willful defaulter or not. Again, it will be a detailed verification only through that the auditor may be in a position to get it. And also management representation, parallelly Schedule 3 disclosure by the management will also be there, so that at least to that extent I am getting protected. It's based on the information explanations available to me that I will be going accordingly. I'm not a fact finder here.
True. So only based on the available information we can.
Absolutely, ma'am. Madam, 365 days, 24/7, the company is operating. I'm then going there and then for limited purpose, how come I may be in a position to do some magics and then get everything out of it? Absolutely not possible. That's fact.
And in your point 18 in CARO, you had mentioned that with respect to resignation of auditors, the issues or the concerns or objections raised by the previous auditor has to be taken care of by the present or the incoming auditor. How does it really happen?
It's a very good question. Basically, at the time of resignation, what happens? The auditor needs to provide the reasons for his resignation. On what basis? Why he is going for a reason? So in that particular case, he needs to be very specific. It's not an ambiguity, or there cannot be an ambiguous answer that he can include it. Where even there is a implementation guide of withdrawal of an engagement by AASB, which clearly says, say for example, the previous order says under health grounds I am resigning. It is a very it is a very vague reason for that particular resignation. You need to be very specific. Or the previous auditor says pre-occupation. Already I have been preoccupied, so I am now resigning. Again, this will be a problem where it is not a valid reason for their resignation, because at the time of acceptance of this particular audit itself, I know what are all my commitments, and then still I am giving my consent letter to take up this particular audit. After taking up, in order to protect the entity and also to protect myself, just like that, I'm going out by stating that I have a preoccupation. It's not a valid mode of acceptance. All this triggered because during 2019-20, there was a huge resignations that was happening, and even for listed companies this was happening, and then SEBI was identifying some unusual resignations that took place. That's why they have also told that in SS 210 at the time of acceptance letter itself, let the management include a particular clause, let them do the 3-quarter audit, means the 4th quarter also to be done, and then only they can go out like that. The conditions and all, they try to impose it. So here, the incoming auditor, what he has to do is, he needs to go through this particular ADT3, wherein the reasons for the resignation of the previous auditor has to be read by him. And if at all there are any reasons, say for example, the management is not providing the data and sufficient information is not provided for, or there are restrictions in the scope of audit, because of such particular issue that the auditor goes out, the incoming auditor has to anyway communicate to the previous auditor, is there any professional reason why I should not accept this assignment? Then in that particular case, all this will come out basically, so that the incoming auditor will not be able to take up that audit also. This will be a hypothetical case. It will go to the vision of MCA, and then there may be further action that could be possible. So in order to trigger out all this, these questions have been included. Another perspective is, at the time of resignation, this creates a casual vacancy. The board of directors can fill up the casual vacancy within 30 days timeline. Previously, under 1956 Act, when there is a casual vacancy on account of resignation of an auditor, board of directors cannot fill it up. For other reasons only, board of directors can fill it up. But now under Companies Act 2013, board can fill it up. But still, they need to go and get the approval of the shareholders within a period of 3 months time, if at all there is a resignation. In that particular shareholders meeting, the board needs to put it as an agenda item, why the previous auditor left, what's the reason that we have stated, why I am appointing this particular new auditor, all needs to put for a deliberation. It all makes indirectly more corporate governance, more visibility that's happening. That's the reason for this, and that's also the reason for including the same under CARO also for reporting by the auditor.
Can there be another perspective where the CARO 18 requires the observation or the issues which have been stated by the previous auditor with respect to the audit of the company per se?
Correct.
So that
you are right.
Unaddressed, getting addressed by the incoming auditor. Can it have that kind of a perspective?
No, that should not be a perspective, because anyhow SA 510 will be applicable. I'm doing an initial audit engagement. This will be a initial audit engagement for me, and then the predecessor auditor has taken up that particular work. Anyhow, I need to mandatorily consider as per standards on auditing. That will be a part of my audit procedures, and that will be part of my audit process by itself. Not a specific disclosures to be made per se from the audit to the shareholders need not be a reason. If that being the reason, then every new incoming auditor has to go for that. Say for example, one term the auditor has completed and the new auditor is coming in. In even that particular case, the previous auditor's concerns, previous auditor's issues, observations and all will be considered by him, but need not be reported. But here, there is a resignation which creates some alarming, which is a red flag, which is to be looked into very right perspective. Is there anything danger, or it's normal that's happening like that? To bring in the facts could be the objective of bringing this particular reporting.
Okay. There's one final question. On material uncertainty, we had a discussion on that. So is there any specific threshold for this material uncertainty?
No, madam. See, always materiality is a subject matter. It's based on the judgment of the auditor, where materiality is not defined. It's basically defined as an item will be treated as material if its misstatement could influence the economic decisions of the users. It will be treated as materiality. Again, based on the circumstances, applying the auditor's judgment, an auditor can go for treating that item as a material or not. With regard to material uncertainty is concerned, there are indicators that are given in SA 570 itself. There are like financial parameters, operational parameters, other parameters. If at all these cases are happening, it will be material uncertainty. Dear auditor, just like that, don't go. You look at there and then make a careful analysis, conclude, and then go. So it's like a speed breaker. You need to necessarily take your leg from the accelerator, slow it, and then only you can go. Otherwise, it is not right approach. So the material uncertainty, there is no specific threshold limit like 1 lakh, 5 lakh, 10 lakh and all. It's based on the this judgment of the auditor, but the parameters that are given in the SA 570 has to be applied. Say, for example, a fixed term borrowings approaching maturity, I don't have a realistic prospectus to repay the same, will be treated as a material uncertainty. My working capital crunch will be treated as a material uncertainty. My net worth erosion will be treated as a material uncertainty. All these are all an event or a condition which may cause significant doubt on the ability to continue as a going concern. So that will be to which is mandatorily to be reported, which is to be disclosed. That's the underlying point. If it is not disclosed, automatically it will be treated as a material misstatement in the finance statement, where we need to go for a modified opinion, and clean opinion will not suffice.
Okay. I think we have really exceeded the time allotted to all of us.
Absolutely exceeded.
Yeah. It was really wonderful. On behalf of FRRB, ICI, and Chengalpattu District Branch of SARC of ICI, I'm very glad to thank you all for the presence today, and also specifically thank the speakers, Shri C.A. Aditya Kumar and Shri C.A. Balaji, who shared their immense knowledge and expertise with us today. I thank the whole team of FRRB and Chairman Shri Durgesh Kumar and the Vice Chairman Abhay Chachit for providing approval to our branch for hosting this program and supporting us in making the program a grand success. I also convey my sincere thanks to the management committee members of the Chengalpattu District of branch of SARC of ICI for their support. I'm also thankful placing this record my heartful happiness and thanks to all the participants who are instrumental in making this program a grand success and who have stayed throughout with us. Thank you all. Take care.
Thank you, ma'am.
Thank you. Thank you, Aditya sir. We'll